The key driver of this bull market has been AI and tech.
We're becoming still very dependent on a smaller handful of stocks.
As investors, what we need to do is separate out what is the medium-term trend from the short-term cyclical trading trend.
Next year, we do see earnings improving 10%.
We have Q3 earnings coming up. We don't have a beat and a raise. I think you will see a pullback in the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, finding some stability. Equity futures inching higher after pulling back from all-time highs. As Fed Chair Jay Powell is suggesting stock markets are highly valued, Alibaba surging towards 4-year highs after revealing plans to ramp up AI spending. Those spending plans just keep on growing.
Look, there's a lot to unpack here with Alibaba and the Chinese presence and where exactly they'll invest. But in a broader landscape, we were talking yesterday about the fear of circular investing and whether this is potentially 1999 type behavior in big tech. The real issue is there still is fear of not investing enough, not about wasting money. And Sam Altman, the CEO of OpenAI yesterday, was saying ultimately maybe people will get burned, but there still is the promise that truly will come through.
Evaluations are high, but the spending is real. Listen to these numbers from Baba this morning, anticipating overall investment in AI accelerating to some $4 trillion worldwide over the next 5 years.
And it's not just Alibaba. Last night, we heard from OpenAI and what they're doing with Oracle in terms of Stargate and that expansion. Micron talking about a better forecast because of AI demand. What I find interesting is this morning, just in the past 40 minutes, Axios is reporting that a group of CEOs are getting together, and as of today, they're starting a huge ad campaign like the DocuSign CEO to push companies and governments to speed up their efforts to adopt AI. Well, in order to adopt AI, you have to have the infrastructure in place. You have to have the right individuals working these kinds of jobs. When is this going to be a ton of pushback and maybe some regulation coming out of Washington?
Just to put this into perspective, I keep going back to OpenAI, especially after our conversation with Gil Luria yesterday, talking about how maybe this is excessive. The $850 billion expansion that they have planned is equal to the output of 17 nuclear plants. It could power 13 million American homes. This expansion is fast and furious. Some people say it's appropriate. Other people say there are bottlenecks. Other people saying ultimately it cannot be done. But this is the scale of what we're talking about.
But talking about this circular market, one analyst had the best take yesterday. It's kind of like having your parents co-sign your first mortgage.
The stock keeps climbing. Alibaba up by 9% in the pre-market so far this morning. Equity futures up by about 1/10%. Coming up this hour, we'll catch up with Peter Tchir of Academy, with stocks looking to bounce back. Harald Hendrikse of Citi, as global automakers face a tough test from China. And we'll catch up with Dutta of Renmac as Powell confronts a very divided Federal Reserve. We begin this hour with stocks rising as Alibaba becomes the latest tech firm to ramp up AI spending. Peter Tchir of Academy writing AI is only the second or third inning, maybe even the top of the first. The issue is whether valuations are in the eighth inning. Pete joins us now for more. Pete, good morning.
Yeah, good morning.
Hey, good to see you. Let's just talk about the spending plans. What's your reaction been to the news that's come from Oracle in the last week, from Nvidia in the past few days, from Alibaba from this morning?
You know, it's all clear that spending is still going away. It's coming in. It reminds me a little bit, though, too, at some point, remember when you had to have a Chinese plan? And if you had a China plan, you announced your China plan, your stock spiked 10%. So we're in that sort of moment where everyone who announces plans to spend is rewarded. And if you announce that you're going to spend $10 billion, your stock goes up $20 billion, why wouldn't you? So I haven't yet seen that change. I think at some point we're getting closer. People are starting to poke more holes in this. And separately from that, though, I am watching what Bob is doing separately, because when I look at everything that's going on in the world, trade, tariffs, etc., China has control over the rarest critical minerals. We have control over the AI chips and data. China's trying to work their way in. It's encouraging that they're using NVIDIA chips. But I think that's going to be a real battle line to be drawn.
Well, let's build on that. Do you think the U.S. is at a disadvantage?
I think the U.S. has a huge advantage right now in terms of chips. I think China has this big advantage in terms of the processing and refining of rare earths and critical minerals. We're taking some steps, whether it's investments in ticker symbol MP. There's noise about more investments of those sorts, whether it's antimony, lithium. I'm sure there's going to be enriched nuclear, enriched uranium investments. Those are the things that we're doing to try and defeat that. But that's a multi-year product. And then at the same time, it felt like China was going to be very easy to work with in terms of dealing with NVIDIA. they seem to be setting a line in the sand where they're going to be, we want to use Huawei more and more. So that's what I'm watching most carefully.
There's a lot to unpack there. You mentioned that, yes, the Chinese government has been pushing their tech giants to invest in domestic companies and domestic chips, and yet what you just mentioned was Alibaba. Right. They're using NVIDIA supplies, right, and they actually have a new project with robotics that they're also really relying on NVIDIA for their supplies. So how feasible is what the Chinese government asking for?
That I don't know, and I think maybe part of it's just a negotiating ploy, because again, everyone's now figured out maximum leverage. So you say these things, and then you walk into a room with President Trump and try and get what you can. Having said that, China plays a long game, right? And they were nowhere in AI a few years ago. They are working their way towards that, whether it's a DeepSeek type technology, whether it's what the Huawei chips that are going on. So I would not completely dismiss them, right? They are starting this kind of steamroller effect. They're currently losing, but I think they plan to catch up, and we've got to be very cautious of that. I do think this is a big win for NVIDIA. I think it's awesome for us, but this is not given. I think if we take it for granted that it's going to keep occurring, that's the risk. Going back to your initial point, the idea that we're in the 8th inning, even though we're just in the 1st or 2nd inning when it comes to the actual production, 8th inning evaluation, at what point does it get too far ahead of its skis? I think it's when you start seeing these announcements and the stocks don't pop, right? When someone announces a $20 billion spend and their stock goes down by 30, 40 billion, then you're like, okay, people are now tired of this. People have kind of sense the valuation. I think
I'm laughing because we had that for a hot second, and then that reversed again. But carry on.
And the other strategy that has worked so well is momentum, right? Momentum tends to work. These have been big drivers of momentum. If momentum starts turning around and you see the CTAs and people get forced out of trades, but we're nowhere close to that, right? Every dip gets bought right now. I'm not seeing what's changing that. The one thing that I found both encouraging and maybe worrisome for big tech is the Russell 2000's finally outperforming. I think, not by much. I think it's up 3% in the past 5 days. NASDAQ 100's up 1%. But that's where I'd like to see the shift, is to a broader expansion to more stocks performing well.
Peter, I'm glad you brought up the rare earths issue, because Representative Adam Smith was in Beijing yesterday saying, I don't think we resolve that. Is the U.S. potentially willing in these trade negotiations to give up other issues they care about because they are so desperate for these rare earths?
I think we might have to at this point. And again, I think we've got to be really careful. It's not the rare earths and critical minerals themselves, it's the processed and refined versions, right? We could go and buy rare earths, critical minerals on the open market. Where are we going to get the processed and refined versions? China controls about 90% of that. And so I think that is very true. And I always go back now to COVID, and I think it was the Whirlpool CEO said a washing machine that's 99% done is not done. And I think that's the problem with these rare earths and critical minerals. They may only be a small component of each product, but they are literally critical, no pun intended. And that's the issue. So we are going to have to give in until we build out our own industry.
What do you think it is that the Chinese desperately want that we're going to have to be willing to give in?
I think it's probably going to be chips for now. I think they, as much as they say they want their own business, they're going to try and get as many chips in the door they can while they want it. And I think they're also just buying time. They're playing this while they try and solidify their trading relationships with other countries, right? While we're trying to sell chips into the Middle East, I'm sure Huawei right now is trying to sell chips into the Middle East. So some of this may be just a delay game by China till they get, I think time is on China's side if you're China, because they watch the U.S. We're very distracted. We have so many things going on internally that they can just keep their machine moving. And if they can distract us, that's fine by them.
The White House is making a move. MP Materials being the blockbuster one of the last year or so. And then you've got the potential for an equity stake in Lithium Americas. That crossing the Bloomberg this morning. The team has been reporting on that. How are you thinking about the prospect of increased intervention, an increase between public-private partnership going forward from here?
Well, my starting point would be, I think I mentioned in this weekend, it's you may or may not like what's going on, but you certainly have to trade it. So if you're investing in this market, whether we like this intervention, whether we like, this ability to play kingmaker, I'm not sure that's the right direction. Having said that, in the old days, right, the CHIPS Act, right, it just gave grants, but the grants were tied with policy strings. So I don't know, maybe we're better off investing. It's tricky, but I do think right now you're supposed to be scouring the universe for $5 to $10 billion companies or smaller that do things. So I've been involved myself directly in enriched uranium. I think there are other products like that. They're going to take off because this government needs to jumpstart it. And again, if you go back to what they did with MP, it was a relatively small investment. I think it's kind of the tip of the iceberg what we might be able to do out of a sovereign wealth fund. But they also helped provide, $1.1 billion of loan guarantees, right? And that, to me, that's how we spur this growth. So if we go down that path, that's how we have a chance. But it's still a 3 to 8 year process.
This is the challenge, Pete. If you are a child of Reagan or Thatcher, you've got to park your feelings about this and let it go. This administration wants to pick winners. Are you saying that when they pick winners, you want to go along for the ride?
I think so. I think, to me, in hindsight, it wasn't surprising at all. And I owned Intel. I think I talked about owning Intel. And not a shock that Trump would maybe ask NVIDIA to get involved because Trump wants Intel to do well. Like, Trump likes winners, right? That's all he's ever done. He's going to back winners. He's in a strong position to push these things. So whether you like it or not, I think you have to accept that this is the current administration's view. These things are going to get support. So you want to look for those. And you've seen so many stocks take off, but I think we're still early stages. And this is all without an official sovereign wealth fund, which I think something that is coming down the pipe for that before the year end.
This is something that David Rubenstein yesterday of Carlyle was talking about, that essentially that is the model that we seem to be following with the stakes that we're taking in a number of companies. And it seems like the United States is moving from fiscal dominance as sort of the backbone of the U.S. economy to something that looks more like a sovereign wealth fund, and exactly what that looks like still remains to be seen. I just wonder how that changes investing, whether that shifts some of the macro investing landscape and shifts it over into deep value, looking for these specific sectors, looking for exactly strategically what makes sense. It's a very different framework of investing.
Yeah, one of the things we're trying to do is look at AI and look for companies that have been most impacted by regulation and say, okay, if you've been heavily impacted by regulation, is that an area we can get deregulation? I think finance companies are doing very well, right? I think people are looking forward to what can be done on this. And then I would say this is global too. I know, the UK Prime Minister didn't completely agree with Trump, but I think this whole concept of production for security is global, and every country has to be thinking, what can you produce at a minimum level? It doesn't have to be fully. You need to make sure that you have energy. You need to make sure you have a chip industry, right? England wants to be a data center capital of the world, but they don't produce any energy and electricity. How are you going to do that?
Not exactly the traditional way of building a sovereign wealth fund, is it?
No.
This isn't typically how you go about doing things.
Well, not especially through a back door where people don't understand what the parameters are, or exactly what's going to go in, or exactly how big it's going to be, or exactly how the revenues are going to get distributed afterwards. Look, there's a lot of question marks around this. But fundamentally, from a philosophical perspective, it seems like maybe the limits of fiscal dominance have been reached, and people are asking for something else as a tool of national security. And the idea of taking stakes seems to be it, whether you agree with it or not. And I think that that's a really interesting change in the investing landscape.
They haven't outwardly stated they want to do this sovereign wealth fund, but it's obvious everything is about national security. MP Materials, when it comes to Lithium Americas, when it comes to Intel. This administration doesn't like grants. They don't like loans. They want outright equity in a company.
Big fan of what?
Yeah, and I would just add that, we're looking at these companies that we need to jumpstart, and people are worried about if everything's just done via executive order, does it get overturned with some new administration? I think these stakes change that. It makes it harder to overturn some of the progress that gets made. So I think that might be kind of the secret sauce here, is by investing, owning, giving the American people this, it lets people push forward on deregulation and assume it's going to stay longer than it might otherwise.
Pete, you're going to stick with us. Peter Tchir of Academy. Equity futures this morning bouncing back by 1/10%. Let's get you an update on news worldwide with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. During a meeting with Ukrainian President Zelensky at the UN, President Donald Trump said NATO nations should shoot down Russian aircraft that violate their airspace. Separately, the president saying on Truth Social that he believes Ukraine can win back all of its territory from Russia. He also said Moscow is fighting aimlessly and even calling the country a paper tiger. Meanwhile, China says it will no longer claim developing country status in the World Trade Organization. It's a change long demanded by the U.S. because China is the world's second largest economy. The decision is seen as a significant gesture, particularly as China looks to negotiate a more lasting trade deal with the U.S. And as you all were discussing, OpenAI is expanding its data center push under its plan dubbed Stargate. It plans to invest about $400 billion to develop 5 new U.S. data center sites in partnership with Oracle and SoftBank. This marks its biggest push yet to fulfill an earlier pledge to spend $500 billion on AI infrastructure in the country. That's your Bloomberg Brief. John?
I'm just losing track of the numbers now. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, permission to defend.
Do you think that NATO countries should shoot down Russian aircraft if they enter their airspace?
Yes, I do.
Team coverage up next with Bloomberg's Tyler Kendall and Ollie Crook, live from New York City this morning. Good morning. Live from New York City. Welcome to the program. Equities doing okay, up by 0.2% on the S&P 500. Under surveillance this morning, permission to defend.
Do you think that NATO countries should shoot down Russian aircraft if they enter their airspace?
Yes, I do.
Would you back up NATO allies?
Depends on the circumstance, but, we're very strong toward NATO. NATO's stepped up.
So here's the latest this morning. President Donald Trump encouraging NATO allies to shoot down Russian aircraft that breach their airspace. NATO pledging, quote, a robust response to Moscow's reckless actions. Our team coverage starts right now with Bloomberg's Tyler Kendall in New York, Ollie Crook in Brussels. Tyler, a very different tone from the president yesterday.
A very different tone, John, and really a main theme that we saw emerge was President Trump bolstering his support for Ukraine on multiple fronts while also urging our European allies to do more to pressure Russia. Now, you heard him there saying that he thinks that NATO allies should be able to shoot down Russian aircraft if they violate their airspace after a slew of recent incidents in the recent weeks, including in Poland, Romania, and Estonia. But then President Trump did go on to say that it's unsure what the circumstances would be and whether or not the U.S. would support NATO if it engaged Russian planes. Those comments didn't really seem to bother much of our NATO allies. I did have the chance to sit down with the Finnish President Alexander Stubb on the sidelines of the UN General Assembly yesterday. He said that he wasn't really concerned by that comment from President Trump. He believes that the president is firmly behind NATO, but that ultimately he urged caution against our allies engaging with Russia militarily, saying that there is a very strict protocol to follow. I can say, though, that there was this palpable sense of excitement from the Finnish president after President Trump posted on Truth Social what really felt like a stunning shift, a stunning development, saying that he now believes that Ukraine is poised to win back all territory concessions. This came after he met with the Ukrainian President Zelensky on the sidelines of the UN General Assembly. But really, John, after months of this administration repeatedly saying that Ukraine would have to give up territory in order to end the war.
Ollie Crook, it feels like we're entering a new phase. And the first country I thought of was Poland. How did Poland respond to those comments?
Yeah, so there are a couple of different sort of strains to follow. When you think about what Trump was saying in terms of encouraging European countries to sort of shoot down Russian jets if they enter the airspace, there are kind of really different divided ways in which Europe have interpreted that. As we've been reporting over the last couple of days, Poland has taken a very hard line. They said, listen, if you're in our airspace, we will shoot you down, no question about it. I caught up with the Estonian prime minister, who was really the source of this latest development, where you had those Russian jets, 3 combat-armed MiG-31s that were in Estonian airspace right by the capital for 100 kilometers. He took a much more measured approach. He said, basically, we have protocols in NATO. We were going to engage with those, but we're not going to say that there's a red line here or a red line there. And then we also heard from the Germans, the German defense ministry, who said that basically slapdash comments about taking planes out of the sky and all these sorts of things are actually really not that helpful. We need to be much more measured in our approach, and we need to basically not play Russia's game. Russia, they say, are just trying to instigate the Europeans to shoot something down potentially, and then basically have the Russians say that they are the victims of all this. But again, I think that for me and for the sort of reaction from the Europeans, though very positive to what Trump has said over the last 24 hours, there is a high dose of skepticism because, as we know, 7 months ago, almost to the day, Jonathan, you had the two presidents sitting in the exact same configuration in a very different kind of meeting. It shows you how far we've gone in that relationship between Zelensky and Trump, but it also tells you how rapidly things can change. So I think very welcome here in Europe, that said with a little bit of dose of skepticism as well.
Ollie, appreciate the update. Alongside Tyler. Tyler, great work yesterday. Thank you. With us around the table, Tchir of Academy Securities for a further few questions on this topic. Pete, let's continue this. Do you think Russia's going to test this new red line?
Yeah, I think that these have not been accidents. We recorded a podcast yesterday at Academy Securities. We talked about this. They are pushing it, right? And we have to figure out what's an appropriate response. How do we push back? What do we do about this? And it will be a NATO state. It won't be the U.S. attacking, but it's the U.S. command and control systems. We're an integral part of any sort of defense and any action that takes place.
Well, what's the difference? Trump said yesterday, we will continue to supply weapons to NATO for NATO to do what they want with them. The United States is NATO.
As an organization, that is true, but each country does have some degree of, sovereign. It's, reminds me a little bit. It's, we all put up with Iran having these proxies, right? And Hamas isn't really Iran. Well, it is. So I think you're going to get into a little bit of these games where maybe Poland will behave differently than in Estonia because Poland feels more threatened. Maybe Poland feels more, up to speed on the ability to do something. Maybe Estonia doesn't. But I think there is going to be a change where everyone's got to sit down and say, okay, this is a new thing for Russia. How do we respond? What do we do? Because the one thing you don't want to have is something that becomes, they're regularly incurring. Oops, they went really all in this time and killed someone. So I think they are going to be red lines, and this is going to be aggressive, and it should be pushed back, or else Putin's going to keep doing it.
Is Putin testing the resolve of NATO or testing the response of the United States?
Probably a little bit of both, and I think his hope though along the whole time has been to somehow fracture NATO, and maybe this is how he does it. It's like, okay, which countries will support this? Maybe a Turkey, for example, won't be comfortable doing this. Maybe a Hungary won't be comfortable doing this. Maybe Finland really wants to do this, but could you create some sort of divide? I think again he will fail. I think he has misread how his invasion of Ukraine coalesced NATO, and I think this will do that once again.
That said, we still haven't seen the sanctions that have been threatened. Yes, there are some stiff sanctions placed on Russia, but not the secondary sanctions that would curtail a lot of the revenue still coming into the country via oil sales.
My starting point is we just need to enforce the sanctions that are already in place, right? To me, there's two things. We've got a set of sanctions in place. Some are being defied by effectively, India, China. There's very little we can do about that. So we can address that with secondary. But first, if Europe's going to continue to buy, Russian oil, whether directly or via Kazakhstan or some other third party, they're not helping themselves. So I think step one is enforce the sanctions that we already have in place. Let's see what that does. And then maybe you can go to secondary sanctions. How do you tell India, we're going to put secondary sanctions on you? Meanwhile, half of Europe's buying energy on, it just doesn't make sense.
It also was sort of mind-boggling yesterday. President Trump was talking about how one way to counter Russia is to lower oil prices, to reduce the revenues. And you saw oil prices go lower on the heels of that. How feasible is that going forward, given how low prices are, given the fact that we could be facing a global economic reacceleration?
My working assumption this year has been it's going to be very difficult for oil to get much above 70. I think Trump has a handshake agreement with the Saudis that if oil goes higher, they can come and push it on the market. That's what they get in return. They get to buy NVIDIA chips. They get to jumpstart their data centers. So I think there's all these transactions going on behind the scenes. So I'm not too worried about oil prices going higher.
Why are German stocks up almost 20% this year? Why are European banks up almost 60% this year? The conversation we have about Europe is pretty dreadful still. And yet here we are talking about major gains.
I think a lot of this still comes down to, okay, will they actually spend to do the defense spending, which would be a new initiative? I think that helps. Will you start seeing deals in Europe?
Can I just ask you, help who? The ECB's forecasting 1% growth for next year. Who's it helping?
That I don't know. I think, though, to me, one of the big wild cards that we're looking at right now is, and I think Trump mentioned this 2 weeks ago, no one's paid attention to it, he kind of gave the nod to Europe to go after Russia's frozen FX reserves. And about 300 billion of that is in euros, sits in the European system. If Europe starts going after that as part of this maximum pressure on Putin, right? One, it allows them to buy the U.S. weapons. It keeps yields down because they don't have to actually issue debt when they get this. And I think that's the sort of thing that, if you're taking a multi-pronged approach, you threaten Putin with some war, which is one thing. Then you really start taking away his money. That's another thing. I think that's the direction you go, and that leads to some growth. And I do think all the things I've been talking about, this whole, production for security, people are starting to realize Europe's going to have to do some of that themselves. Right? You can't rely just on wind, just on solar. You need to go through this. So I think those are the opportunities, and banks are going to play a big role in that as there's going to be hopefully M&A and transactions going.
Well, Pete, they're certainly having a big year, that's for sure. A monster year for 25. Peter Tchir of Academy Securities, a monster rally for European banks and European equities.
There's been a lot of promise despite some of the slack expectations for growth. And a lot of this comes on what Pete's talking about, the idea of investment, the idea of the investment fund from Germany. But when you actually look at the data, there have been more positive surprises to the economic data coming out of Europe than negative ones. I don't know if that just tells you that the expectations are very low or that there is something going on that gives people a little bit more optimism.
I'm not sure that massive defense spending was the main pillar of the Draghi plan. I might be wrong, but I'm not sure it was.
You're not wrong, and you know that you're not wrong. The issue is, how do you get an entire region full of different countries to agree on deregulation and changing some of the culture around work and job creation?
Energy prices are too high, Germany, the UK. They're being consumed by Chinese automakers, seeing that in the UK, in various places across Europe. Europe is not in a good place. I know we're all excited about European bank stocks, but not in a good place. From New York City, this is Bloomberg. This headline just crossing just moments ago. It comes from the EU to propose a tariff increase on oil imports from Russia. Something's building here. The president's been pushing for some action. The Europeans seem to be on board. We're heading in this direction.
Well, the president pushed for it once again, even yesterday at the UN, and Truth Social post saying, I'm willing to do more when it comes to sanctions, but everyone needs to be alongside me, all our allies. And he's not just talking about India anymore. He's talking about the European Union. They've been talking about this for a number of weeks and months, and it looks like finally they are starting to put this together. They will have this increase because, remember, they are still one of the top 5 buyers of Russian fossil fuels.
Crazy.
And this war is happening on their soil.
Check out the price move. We're up by about 0.9% on Brent so far this morning, up by almost 1% on WTI, $64 and $68 respectively. That's the situation in the commodity market. Let's turn to equities. Equity futures shaping up as follows on the S&P, on the Nasdaq, on the Russell, and the S&P pulling back from all-time highs in yesterday's session, firmer this morning by 0.1%. On the Nasdaq, up by 0.2%. In the bond market, 2-year bond yields a little bit lower yesterday across the curve. Following 4 consecutive days of higher bond yields, we're back down to about 356 on 2s. On 10s, just about unchanged on the session at 410. No real sign of what Chairman Powell wants to do here, at least yesterday. But I have to say over the last week, he has picked a side. And the side he has picked is the labour market, and it's not inflation. And you should follow what they do, not what they say. They're cutting interest rates, and they're going to continue cutting interest rates.
Yeah, he gave more noise around that yesterday with respect to potentially the immigration impact on the labor market. And it could be a false signal. At the same time, it seems like something has shifted for him. That comes along with Mickey Bowman saying we need to aggressively lean into saving the labor market, and this is an important moment to do that. That, I think, got a lot of people's attention.
We risk being behind the curve.
Exactly.
Yeah, Governor Bowman is no longer hawkish, let's put it that way.
I think that she's in the running, is what I think.
And now one of the biggest dumps on the committee about Governor Myron. 3 hours away from the cash open. Let's get you some single names. Some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Alibaba shares flying this morning. The ADRs trading 9 1/3% higher. Alibaba's CEO saying that they are going to not just be incrementally increasing their AI spend, but it is a whole shift. Before they had said something like $50 billion over the next 3 years. He said it will be more, also touting their full stack service, everything from the data centers, the infrastructure, the software behind it. So that CapEx continues to be a good story for investors. Meanwhile, Micron, also an AI boost for them. Expectations were so high for this company to perform. Share prices have nearly doubled year to date, and they gave a forecast for this current quarter that exceeded expectations. So even though the move is only 0.6%, that is good for Micron considering just how big of a run-up it had been into this earnings season. Now, elsewhere, Lithium Americas, it's a Vancouver-based company with one of their large mine operations in Nevada. People familiar telling Bloomberg that the Trump administration is looking at converting a $2.3 billion loan from the Department of Energy into a 10% equity stake in the company. Again, it is that Nevada mine, which is set to become one of the biggest lithium producers in America. So the administration looking at coming in there. GM had owned a stake in that mine with Lithium Americas. And before this, they'd already been looking at renegotiating the terms of that loan, saying they couldn't meet the conditions. So that possible equity stake has shares up 54%, John.
What a move for that stock right there. Danny, thank you. Appreciate it. On our radar this morning, President Donald Trump saying NATO nations should shoot down Russian aircraft that violate their airspace. Trump adding on Truth Social he believes Ukraine can reclaim all of its territory, calling Russia a paper tiger. Elsewhere, OpenAI partnering with Oracle and SoftBank on a massive $400 billion investment to build 5 new data centers. The facilities located across Texas, New Mexico, Ohio, are part of OpenAI's Stargate infrastructure project. And finally, Alibaba shares are surging to a near 4-year high after the company said it would boost its AI spending beyond its original $50 billion plus target. The company's CEO predicting global AI investment will hit, wait for this number, $4 trillion in the next 5 years.
It just sort of underscores how people are scared of not investing enough, not that they're investing in a way that's going to throw away money, good money after bad. I will just say it's interesting that Alibaba is working with NVIDIA. So despite some of the feelings that maybe the Chinese government's going to push Chinese technology companies away from U.S. chip providers, isn't exactly transpiring. But what this speaks to is this global wave of investment that is continuing despite some of the people here in New York City wringing their hands and saying, it's a bubble, and they're coming out and they're saying, look, this is the future. You can get on board or you can leave.
For China, my big question after this story using those NVIDIA chips is, what's the goal? Is it strategically you want to win in the AI space? You're going to use all technology at your disposal? Or do you really want to push for chip sovereignty and at the end of the day, make sure your national champions are the ones that are pushing into your own companies? And I think this is an interesting moment right now, and I wonder if it sticks. Are we just here for this moment right now, or China is going to force these companies to move inward?
Important takeaway. We often say this on the program. You can learn something from the news, the declaration, the data point, and you can learn something from how the market responds to it. I think it's far more interesting that the market is responding still positively to these additional spending plans, which is something Peter Tchir reflected on about 20 minutes ago.
Yeah, naysayers in New York aren't really doing anything for the share price, because ultimately, if you can promise $10 billion of spending and then you get $20 billion market valuation pop in your shares, well, you're doing something right. And he said that the real key that this had moved too far is if you don't get that kind of reaction in markets. And so far, we're nowhere near that.
Investors like it, so the promises keep coming. Investors like it, the promises keep coming, and we'll see how long they can keep this going. Let's stick with China. Global demand for Chinese exports is surging as the world's second largest economy is on track for a record $1.2 trillion trade surplus, despite the tariffs that came from the US earlier this year. Harald Hendrikse, the European autos analyst at Citi, joins us now on what all of this could mean for the auto sector across the continent. Harald, good to see you, sir.
Good morning. Good morning.
Thanks for being here. Let's just talk about the EV strategy from the Europeans. So we had the news out of Porsche yesterday that they're tapping the brakes, so to speak, forgive the pun. You've got three options, really. Double down, muddle through, back away. What are the automakers picking? What are they choosing in Europe?
In reality, they don't really have a choice, right? You've got three completely different EV strategies across the world, right? The major markets, Europe, US and China. You know, China is surging ahead, both technology-wise, subsidy-wise, and overall penetration of NEVs, right? Europe is muddling through with, frankly, very difficult regulations that are a significant competitive disadvantage for the European car companies, which are now potentially being renegotiated, right? We restarted negotiations on the 12th of September, so we'll see what comes out of that. And then the US, as ever, going completely the other way. So if you're a car company, you have virtually no EV penetration in the US, 53, 54% NEV penetration in China, and maybe 16, 17 in Europe. You have to basically cater to all people. So they have no choice. So what Porsche was doing was not so much cutting the EV model plan as basically prolonging the ICE model plan, right? The initial plans were just too aggressive and they're just not achievable. The consumer demand just isn't there.
I do remember when people were talking about Detroit here in the United States and saying ultimately it's uninvestable based on some of the regulatory concerns, the competitive landscape. And I wonder, based on some of the Chinese EVs that are coming into Europe right now, also with some of the regulatory overhang, whether the European auto sector is investable right now.
Yeah, thank you. Asking. I often have this debate with investors, and I'm like, "What other sectors do you do?" I only have the one sector. Look, it's a good debate. Firstly, you know, and again, it goes to the chip discussion you were having. The AI stuff. Growth, right? You know, growth is becoming harder and harder and harder, and investors are looking for growth wherever they can find it. You know, and so you're bifurcating the market also, right? The market's become very, very narrow. And unfortunately, companies like autos and a lot of the older industries are not getting the capital that they need. They have a much higher cost of capital. And so that's, you know, speeding up the decline. The answer to the question is, look, there are names, you know, Ferrari is a great quality name. A lot of the tire companies have much, much better fundamentals. You know, there are some companies, I think Porsche with the brand name that they have potentially could, you know, get better fundamentals. But globally, you know, the Chinese have done what they've done in so many industries, right? The EV industry became a strategic growth asset for them. They have essentially built almost twice the capacity that they need for electric vehicles in China itself. The ICE market, the combustion engine car market in China has halved, but you still have the capacity from what we had before. So China just has this infinite capacity, which allows them to make super, super cheap cars to sell in other parts of the world.
And the place that's seeing a lot of them is European automakers, because ultimately that's where a lot of these Chinese autos are going. And I just wonder how much the European auto sector has to shrink to accommodate what really is coming onto its shores.
Yeah, so look, I mean, you have the Chinese strategy, right? And then you have Trump, right? And unfortunately, Europe is the weak spot, right? And so as soon as Trump put the tariffs on the US, where do you go? You go to Europe. Right? And so we've seen that immediately. So it's not just the Chinese, but it's Hyundai, it's Toyota. Everybody who needs to sell cars globally has gone to Europe because they're short of their budgets in the US. Right? And so you're seeing a huge extra supply. You're seeing really good quality EVs coming into Europe from China. And the reality is the European industry is getting squeezed. Just a quote that I make with investors just to highlight the seriousness of this. So Volkswagen has just embarked on the biggest restructuring they've done in 87 years. They've cut 40% of their German Volkswagen brand capacity. So you build a business for 100 years, and in a single decision, you cut 40% of that business in Germany. Audi, their second bigger brand, right? 25%. These are huge numbers. And it's not just China. Post-COVID, the market didn't come back. The regulatory situation in Europe is terrible, such that it is too expensive to make smaller cars in Europe, right? So the European OEMs have pulled out, but it means that the European car market is now 1.5, 2 million units smaller than it was pre-COVID. So you have a smaller market, more competition, better quality competition, and potentially regulations that are totally unreachable for 2030, 35. It's a very hard situation.
Is this environment going to force the Commission to do an about-face?
I think it is inevitable. So I'm a good Dutchman, and so people always want me to be incredibly bullish about Europe. I tend to have been always the other way around. Currently, I'm a little bit more bullish about Europe today simply because the situation is so bad that people are losing elections, right? Unemployment's a significant problem. You've seen some of the reactions to some of the politics in Europe recently. The European automotive industry in some countries is still representing 11, 12, 13% of total employment. They have no choice. They can't kill it, right? And that's why I'm going around the world highlighting the 40% cuts, the 25% cuts. Wake up, right? You can't restart an industry once you've closed it down. Right, so I think they have to.
Does Europe then need to choose what Mexico is doing and put up the walls alongside the United States to Beijing?
Look, I did an interesting debate regarding exactly that recently, and again, Europe has no choice, right? And this isn't about, particularly subsidies or cheating or anything like that. It's about the fact that China just has a much better industrial policy with regard to all of these things. They've made better decisions 5, 10 years ago. They've created the conditions to have this industry. And we didn't, right? And lithium, we were going to talk about the lithium. We don't even have the supply. We haven't secured our own supplies, right? 75% of global lithium supply refining is in China, right? We don't even have it. So if you don't have lithium, you can't make batteries. If you can't make batteries, you can't make EVs. Yeah, so this is about industrial policy. And basically, to protect the European industry, I think you're right.
Do you foresee a future where China says we are no longer even going to sell batteries? It's buy the car or nothing because they have complete control on the supply chain?
Yeah, really interesting question. It's actually their single most powerful weapon, against the global car industry, right? The global car industry has become, at least on the EV side, very dependent on China. And at least so far, the Chinese have not restricted access to those supply chains. But yes, that is potentially part of it. And in fact, we've seen this with the rare earths as well, right? And this is why, to be honest, thinking about the article that you highlighted to me, regarding lithium, to be honest, the Americans are reacting, and they finally understood that they need to secure their own supply. And whether you do that with government investment or any other way, frankly, I don't care. You need to supply and to secure that supply for yourselves. And so I read this stuff and I look at the Americans, and at least they're doing something, right? I want this to be coming from the EU, and of course, it's never going to. But we need to think about our own futures, don't we?
I have to say, what a pleasure it's been just to sit here and listen to you for the last 10 minutes. Thank you for being here.
No problem.
The fact that the Europeans are killing what you say they shouldn't be killing is just absolutely shocking. It goes back to the conversation we had 15 minutes ago, which is about European banks and European stocks. Put the stock market to one side. Just forget all of that. Look at the state of the economy. The ECB's forecasting 1% growth for the Eurozone next year, even with all this fantastic stimulus that everyone's excited about coming out of Germany. And they are killing one of their own industries. And there's no sign they're going to stop anytime soon.
Yeah, what Harald just said there, that this is an industry that accounts for more than 10% of the jobs in the region. And it is squeezed on both sides, and there is no end in sight. And it is because of regulation. It is because of some other lack of investment earlier. It just raises a question, what is the plan going forward to really protect those jobs, given the fact that right now they're under direct assault?
Unfortunately conditioned by experience. Don't underestimate the Europeans' ability to stick with a bad idea for a long, long time.
Well,
because most people would sit here and say, this sounds terrible, surely things will change. We've been talking about this for years. Not months, years.
Not to be overly philosophical, but you could see this in some of the political fractures right now. And you could see this with a question of, are we reaching a boiling point in the politics around the world? And I think that that really has been the ultimate question. Yes, maybe that people don't want to make bad decisions, but right now there is serious unrest. And I think that that is coming back to the table.
Howard, appreciate this. Let's do it again soon. Next time you're in New York.
Yeah, thank you very much.
Thank you, sir. Thank you very much. Harald Hendrikse there of Citi. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. The typhoon that has lashed Hong Kong in recent days is moving up China's southern coast, where it's expected to hit the area with torrential rain. The storm has led to thousands of flights being canceled, along with school classes and train services suspended. The typhoon, equal in strength to a Category 2 hurricane, has killed at least 14 people in Taiwan. Meanwhile, here, Democrat Adelita Grijalva has won a special election in Arizona, further shrinking the Republican majority in the U.S. House, now leaving them with the 219 to 214 majority. The victory is significant as it gives Democrats the final signature needed on a petition to force a vote on a measure that would release unreleased government files on the late Jeffrey Epstein. And Jimmy Kimmel returned to air last night and addressed controversy over his remarks about Charlie Kirk's assassination.
The truth is, I don't think what I have to say is going to make much of a difference, but I do want to make something clear because it's important to me as a human, and that is, you understand that it was never my intention to make light of the murder of a young man.
It was the first time the TV host spoke publicly since ABC pulled his program off air for saying conservatives were trying to score political points from Kirk's murder. Just minutes before his show aired, President Trump floated the prospect of suing ABC over Kimmel's return. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next, no risk-free path.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path.
That conversation up next with Neil Dutta of Renmac, live from New York City this morning. Good morning. You're watching Bloomberg TV. Equities are bouncing back by 0.1% on the S&P, and the Nasdaq 100 up by 0.3%. That's the market pricing so far this morning. Under surveillance this morning, there is no risk-free path.
The unemployment rate is low but has edged up. At the same time, inflation has risen recently and remains somewhat elevated. Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path.
So here's the latest this morning. Fed Chair Jay Powell reiterating the challenging path ahead as policymakers weigh further easing. Neil Dutta of Renmac is writing the following. Hard data for August has been mixed at best. Meanwhile, survey data for September has been soft. The evidence that conditions are sustainably turning a corner remains thin. Neil joins us now for more. Neil, welcome to the programme, buddy. It's good to hear from you as always. You keep pointing to what's happening with housing. And I want you to explain to us all why that's such a key indicator for you and why it should be for the Fed too.
Well, it just seems to me that, a lot of the strength in the economy is being driven, by things like consumer spending. That's what people have been pointing to, a lot of enthusiasm for retail sales. But it's important to remember that consumer spending has never actually turned down in front of an economic slump. I mean, there are some economic recessions, as an example, where consumption's actually expanding. So that sector is not really the one that gives you the tell. Now, residential investment, by contrast, does tend to turn in front of economic slowdowns, and it's been contracting, albeit very modestly over the last number of quarters. And as I mentioned, this isn't the first time we've seen residential investment slow down since COVID. Obviously, it happened in 2022 when the Fed was rapidly hiking interest rates. I mean, they basically broke housing without even hiking. They kind of used their words to send rates higher. It's different now because builders no longer have a backlog of homes to work through. So units under construction were very elevated in 2022, 2023. That's no longer the case. And the pipeline of future construction keeps dwindling, which is why construction employment is more at risk over the next several quarters. So that introduces additional downside to the labor market, which is, obviously something that matters a lot for the Fed. So, right now you have declines in construction employment. It's likely that construction employment continues to decline because things like housing permits are weak, things like, new home sales that haven't been started are very low. and home prices continue to decline. So I think builders have kind of reached their pivot point on margins. And, that's something that hasn't been getting a lot of attention, quite frankly. And I do think it's very important for the broader U.S. economy.
Neil, I wonder, just to sort of center the conversation, whether you agree with the Stephen Myron view of things, where maybe neutral is more around 2.5% rather than the 3 to 4% that the rest of the committee believes, and that the Fed should really cut steeply. Is that kind of the way you look at things right now?
No, I mean, I think look, if neutral interest rates in real terms were basically zero, which is, essentially where Governor Myron said they were, then the economy and the financial markets would have already collapsed. That doesn't mean that policy is not restrictive. So I do think directionally, he's sort of right.
I guess what I'm trying to get at, Neil, is what you're arguing is something that I think a lot of people would get around, would believe in. And I'm just wondering how different the corrective path is that you're laying out versus what the committee is poised to do on the Fed.
Well, I mean, the committee only has one rate cut in between now and the end of next year. I'm not sure that's going to cut it. I mean, look at what's happening with mortgage rates. I mean, mortgage rates are still elevated. And, while the Fed doesn't control mortgage rates directly, I mean, obviously, longer term interest rates at some level are expectations of future short rates. And so if all you're really going to get out of the Fed is 2 more rate hikes, and then maybe, I mean, the likelihood is potential. I mean, there's a risk that they only go in October and nothing beyond that. They haven't really penciled in much for 2026. So, I think the fact that the Fed path isn't really anything beyond a sort of meeting by meeting approach, that's probably another sort of reason why mortgage rates are sort of are still elevated here.
Neil, even though Jay Powell is talking about risks to both sides, Jonathan made a great point. Hasn't he already showed his bias? Hasn't he already decided he actually only cares about the labor market right now? That's his concern?
Well, yes. I mean, it depends what your time horizon is. I mean, I think he cares about the labor market for the next few months. If inflation starts accelerating, I mean, you can't rule out that they skip December. I mean, why would anyone do that? The committee's so evenly split. People are allowed to change their minds. You still have, I mean, you had a bunch of hawks talking this week too, like Bostic and the St. Louis Fed president. So they're a little bit more circumspect about future rate cuts. And, Powell's job is to kind of forge some kind of consensus within that committee. And, if you get, as I say, if you get an upside surprise on core inflation between now and the end of the year, I wouldn't necessarily say that, a risk management approach, as he's outlined it, would mean, it could mean skipping the meeting altogether. I wouldn't necessarily say that the path is locked in.
Neil, good to hear from you. We'll catch up again soon. Let's get you in the studio. Neil Dutta there of Renmac. Chair Powell said this yesterday in the speech. In addition to what he said back in Jackson Hole, one-time increase in the price level will likely be spread out over several quarters and show up as somewhat higher inflation during that period. That's the Fed chair setting you up for hotter reads. Not in months to come, over the next several quarters. So it's pretty clear, I don't know if he gets spooked by it, but it's pretty clear what his argument is right now going into these Fed meetings.
Yeah, he's going to look through it because he also said we do see meaningful weakness in the labor market. So how much does that really matter for Fed policy?
So far he's picked a side. He can change his mind, but at the moment he has certainly picked a side. Coming up next on the programme, we'll catch up with Barbara Reinhard of Voya Investment Management, Ed Mills of Raymond James, the Charles Schwab CEO, Rick Wurster and Russell Brownback.
6 months ago, it was all panic about who's the next Fed chair. That seems to have slowed down.
A super dovish chair would have some influence on the path of policy, but not just going to come in and get their way.
The Fed is cutting on risk management grounds into what may be the early stages of a cyclical re-acceleration.
In our view, the Fed rate cuts are one factor of many.
If we see the labor market continue to deteriorate, that's something that will ultimately impact consumer spending.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive and bouncing back. We're higher by 0.1% on the S&P. On the Nasdaq, up by 0.3. In the bond market, 4 days of high yields. Met with a single session of lower yields in yesterday's session. This morning, just about unchanged. The 2-year, 356. The 10-year, 411. For the week ahead, it's shaping up as follows. Lots more Fed speak. And it concludes with some important data on Friday, going into the weekend with a look at PCE.
Yeah, the idea of personal income, personal spending, and then this key metric of inflation that the Fed does look at. Honestly, how much is the market caring about this, given the fact that the Fed has said we probably are going to get hotter than expected inflation reads, and we probably are going to look through it? At what point is the headline number going to be important? At what point are we going to be talking about appliances, bars and restaurants? I mean, seriously, how much are we going to go line by line? Is it going to matter if one type of industry is seeing price increases more than another?
It was my biggest takeaway from the Powell speech in Jackson Hole, Wyoming. You were there. It was my biggest takeaway from him yesterday, setting himself up to look through hotter inflation prints that he believes might be spread out over the next several quarters.
Right, and he said that again yesterday, reiterating it, a one-time increase does not mean all at once. He also went on to say, when talking about inflation, especially since you have this split Federal Reserve officials talking about those that are really concerned about the labor market and those that are concerned about a reacceleration of inflation, he says we can't leave that part of the goal unguarded. It almost feels like, well, you already are, because you've already decided this month, that you actually have a bias and concern about a weakening labor market.
That's the Federal Reserve. Let's turn to some single names. Alibaba in the pre-market this morning, higher by close to 10%, announcing increased plans for AI spending, and this stock market just keeps rewarding those headlines.
There is this feeling that there is a transformative moment, that AI will be the new future and could be more transformative than even the railroad or the internet or some of these other areas. So people are saying it is more of a liability to not be ahead of the game, and that rhetoric is working in markets. What's the stopping point for that? I'm not sure. I keep going back to what Peter Tchir said. When the market doesn't respond with a bounce, that's when you know something is afoot. We did see that for a brief second with Meta, going back to their expansion, followed by their restraint and discipline. I just wonder if there's something that's actually going to gain traction.
So far, at least over the past few announcements, the market responding very positively. Oracle, Nvidia, and this morning.
Sam Altman of OpenAI had this to say yesterday. I thought it was really interesting. People will get burned on overinvesting, and people also get burned on underinvesting and not having enough capacity. Smart people will get overexcited, and people will lose a lot of money. People will make a lot of money, but I am confident that long-term, the value of this technology is going to be gigantic to society, and that, I think, is what the market is coalescing around.
Alphabet, based on their comments in the last 12 months, committed to overinvesting. That's the latest on tech. I want to squeeze this single name in too. Lithium Americas, maybe a name you're not too familiar with. I can tell you this morning it's higher by 68% in the pre-market, and reports suggest this White House is getting closer to taking a stake.
And also Lithium Americas this morning talking about how they continue to work with the Department of Energy, where they originally had this loan approved during the Biden administration, and GM on these proposals. It sounds like the U.S. government, though, they don't like loans, they don't like grants. We've seen that before with already them taking stakes like they did with Intel, that 10% stake. They are going directly into these companies that they think there's a national security concern. And you can see that with the direction of travel, Lithium Americas being the latest.
This stock is flying. We'll spend some time on this a little bit later this hour. Coming up over the next 60 minutes, we'll catch up with Barbara Reinhard of Voya Investment Management, with Wall Street tapping the brakes. Ed Mills of Raymond James as President Trump launches a blistering attack on the UN. And the Charles Schwab CEO, Rick Wurster, as Powell suggests stocks are highly valued. We begin this hour as the record stock rally hits some skepticism following some big AI investment plans. Barbara Reinhard of Voya Investment Management remains optimistic, writing, "We remain overweight equities, have been all year. We remain overweight the US." Barbara joins us now for more. Barbara, good morning.
Good morning.
Let's start with that overweight. Let's start with why. What underpins that view?
Well, I think it's all been about earnings, right? So everything that you think about in terms of the equity market, yes, it's had a massive bounce off of the bottom, but more than 55% of it has been driven by earnings. Only 45% has been driven by multiples. As long as companies are delivering on their earnings, the equity market seems to be, poised to continue to go higher.
The earnings story for a handful of tech names has been absolutely phenomenal. the CapEx intention spending plans have been phenomenal as well. And as Lisa was talking about just moments ago, this market keeps rewarding those spending plans. Are we anywhere near the limit of investor tolerance?
Well, I think you have to put it in context. A lot of people are starting to think about, is this like the late 1990s bubble where we had spent a lot of money on overinvestment in fiber, and fiber was being lit and there was dark fiber still to go. But you have to remember, many of the tech companies that were just propelling the market forward on the NASDAQ in the late 1990s didn't have the earnings power, didn't have the free cash flow power that the companies today have. The AI investment, I think, is just starting to scratch the surface. We see it on our teams that we are using AI to help us with repetitive tasks, to help us with quarterly commentaries, to help us with earnings calls. So we're seeing it lift our business in terms of efficiency and in terms of productivities per workers. It may take a while for that to flow through the economic data. We may see the productivity boom 5 years from now on AI, but we do believe it is indeed coming.
Do you believe it enough to wager on the broadening out trend? The idea that the tech advancements are not going to be isolated to a handful of large companies, but that there is going to be this groundswell of support for the equal weight?
Lisa, that's a great point. And I think you have to look outside of the U.S. to talk about that. So this entire year, the emerging markets had been lagging behind the U.S. And even coming off of the April bottom, a lot of global markets had come off the bottom, but the U.S. was leading the way. Just in the past 5 to 6 weeks, you've seen this big trend that the emerging markets are starting to outperform the U.S. But if you look under the hood, it's really emerging market technology stocks are outpacing U.S. technology stocks. It doesn't mean that they're not all going up together, but emerging markets seem to be taking the lead. I think in order to believe in a broadening out of the market, you need to see the Fed continuing to ease. You need to get past this inflation spurt, but you also need to get past this low firing, low hiring phase that the U.S. is in. There is a little bit of nervousness underneath the surface in terms of how long this can continue to go. We think that once you get to the beginning of next year, you've got the fiscal stimulus boost from the big, beautiful bill. You'll have the depreciation write down for companies. So you're going to have a much bigger fiscal stimulus push once you start to get to the first quarter of 2026.
This might be a difficult question to answer. And this was something I was thinking about yesterday. Is it feasible to see a broadening out in terms of which stocks are doing better and inflation coming down? And I ask this because yesterday in the PMI data, it showed that actually companies were having a harder time passing along the costs to their consumers. That means shrinking margins. That means less profitability. That means something for investors that's not very positive. So are these stories kind of in conflict?
Lisa, it's a great question, but I think you have to take a look not only at margins, but the level of margins. Margins are extremely high in the U.S. And yes, companies have not been passing on all the price increases from tariffs, but I would say there's always room for negotiation for those to continue to go lower, and that would be very well received by the markets. So I think you have to take these things in terms of context, in terms of its margins come down from 27% down to 25%. Is it really that big of a deal? But it's a great question.
Barbara, you said you see productivity with AI actually being an enhancement. At the same time, you say we're in this low hiring, low firing regime when it comes to labor market. Do you see companies not hiring because specifically AI?
No, I think it's more companies are not hiring because of a lot of uncertainty, right? You've had a lot of potential shocks to the economy over the course of this year. You had the tariff-induced downturn in April, which was really significant and very severe. I mean, you had very deeply oversold conditions within financial markets. There were a lot of calls that the world was coming to an end, big rally off of the bottom. But I think that this low hiring, low firing is just a matter of companies saying, we need to get through to the end of the year to get some more visibility on earnings. But companies are holding on to workers. If they're holding on to workers, it's because their sales are in good shape, their earnings are in good shape, their profit margins are in good shape. So as far as we see it, the low hiring is a lot of uncertainty regarding the tariffs, uncertainty regarding where the Fed finally settles. But in the end of it, we don't see that this is necessarily the beginning of a labor market unwind.
But don't we already have certainty for the most part? The tariff levels are set. We know the direction of travel. We know the direction of travel of the Fed. What is so uncertain about this environment right now?
I think that when you're thinking about the tariff levels, there's been a lot of negotiating on them. They were set at very high levels. Then they got renegotiated down. There's always room when there's negotiations. You've got to think that is there potential that they're going to go lower if the U.S. hits much of a soft patch. Let's just say this low hiring, low firing starts to go into either an inflationary surge, or if you get into this environment where you have maybe the low hiring and the firing starts to go up, I think that the Fed and I think the administration would likely respond to that. They have a midterm election coming up in 2026. The clock starts actually this November, and they want an economy that is briskly growing for the midterm elections.
I think it's already started, to be fair. I was looking at the PMIs yesterday. Inventory levels not great, new orders not great.
Yeah.
I was hoping things would pick up. Don't see many signs of it. The ability to pass through high prices to consumers, but a pushback there too.
Yeah. But consumer spending has been relatively strong,
It
right?
has been, but I'm just looking at the PMIs yesterday. I think it was a hope that in September things would pick up and reaccelerate. I just haven't seen that yet. I hope that it's backed up by the data points, just don't see it yet.
Well, I think the consumer has been acting like this. They kind of go through these spurts. They spend for back to school, then they kind of go into hibernation, then they spend for the holidays, right? So the consumer has been looking for a lot of deals for a long time. This has to, of course, think through this, this period of where you've got some uncertainty around inflation, and higher prices do scare consumers, right? They start to look for better bargains. They go for, off-label brands. But I would say once you start to go through for the holiday shopping, you may have a lull for October and November. But let's start looking at those kind of after Thanksgiving sales.
We'll do just that. Barbara, it's good to see you.
Nice to see you
Thanks for
too.
dropping by. Thank you. Barbara Reinhard there at Voya Investment Management. Looking for that pickup, that reacceleration into 26.
Just saying, household, if you're listening, I'm not saving my money for some sort of big present in December. No, I'm kidding. But I do think this is really the key question. If you're looking for it, the reacceleration. Right now, it's not clear in the data, and that uncertainty is leading a lot of people to wonder which to weigh more heavily, the labor market or potentially what you're seeing with growth.
Barbara's right, though. Retail sales have been really quite robust.
Totally.
The last print was fantastic. I want to see more of that. And the reacceleration that this equity market is already priced for, we need to start seeing some real evidence of it into year end.
Yeah, you talked to a CEO of an airplane provider, an airline, and they are pretty optimistic. They're seeing it. They're saying people are looking to travel. And I will just say that if you want to book flights to a hotspot this winter during school break, good luck.
What did Scott Kirby say about that to you last week?
Well, that's normal. I mean, if you want to go to popular places, what do you expect? He didn't provide
no
any
discount
particular
from United Airlines.
Well, that's okay.
Bramo's still flying Delta. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Shares of Alibaba and Nvidia are seeing a boost in early trading, with Alibaba up nearly 10% after it announced it will integrate Nvidia's AI development tools into its cloud software platform. That will give customers the blocks to build AI for the physical world, which of course spans everything from humanoid robots to self-driving cars. Meanwhile, hundreds of federal employees who lost their jobs in a cost-cutting blitz led by Elon Musk's Doge are now being asked to return to work. According to the Associated Press, employees of the General Services Administration who manage government workspaces have until the end of the week to accept or decline reinstatement. And Disney is hiking the price of its streaming service. The plan with ads will cost $12 a month, which is $2 more than before, and the ad-free version will cost $19. That's $3 more than before. Disney's not alone. Streaming services have been upping their prices to try and finally convert years of investment into returns. The new Disney pricing will take effect October 21st. That's your Bloomberg brief. John?
Yahira, thank you. Let's give it a minute. It's an important story.
For John.
Hulu Premium, Live TV, Disney Plus, ESPN Select plan. That's going to increase. I got this email last night to $99.99 a month. Okay? So I went back to my old emails because I've had this email a few times.
I've seen the screenshots.
So I went back to like 2018, 2019. This was the email I got from them back then. Your plan's going to increase from $39.99 to $44.99 on February 2019. So in 6 years, I know the plans changed slightly in terms of what they're offering you now, Disney Plus, etc. But in like 6 years, That thing has basically doubled and more.
Do you feel like your enjoyment has doubled? Do you feel like your happiness factor has doubled?
I feel like I'm just as locked in still.
Well, there you go.
I'm paying double.
Exactly. Well, their happiness factor is going up.
Oh, we were talking about the ability to pass on high prices.
Evidently, it's effective.
Hello, Mr. Riger this morning. Okay, up next on the program, a presidential scolding.
The United Nations is funding an assault on Western countries. Both the immigration and their suicidal energy ideas will be the death of Western Europe. Your countries are going to hell.
A conversation up next with Ed Mills of Raymond James. Live from New York. Good morning. Stocks are positive, up by 0.2% on the S&P 500, up by a third on the Nasdaq, on the Russell, up by 0.1. Under surveillance this morning, a presidential scolding.
Not only is the UN not solving the problems it should, too often, it's actually creating new problems for us to solve. The best example is the number one political issue of our time, the crisis of uncontrolled migration. The United Nations is funding an assault on Western countries. Both the immigration and their suicidal energy ideas will be the death of Western Europe if something is not done immediately. Your countries are going to hell.
So here's the latest this morning. President Donald Trump out with strong criticism of the UN, accusing the world body of creating new problems. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. You were over there at the UN General Assembly. Just how well received was that message?
Well, John, if you were looking in the room at the UN General Assembly, it was really met with silence from the other countries who were really just taking in President Trump's message, though I think it might be fair to say that some of these countries at least were expecting the onslaught of criticism, though perhaps not to this extent. Take the Brazilian President Lula, for example. In his remarks right before President Trump, he issued a sharp rebuke of U.S. policies, prompting President Trump in his own speech to say that he intends to meet with Lula next week. Now, we knew going into this that President Trump was going to blast the United Nations as an institution, and our analysts at Bloomberg Economics do point out that since the early decades of the UN's founding, nearly all regions have actually shifted further away from the U.S. when it comes to UN General Assembly votes, and the data shows us that it's actually shifted closer to China. However, with that said, UN General Assembly votes are non-binding, and the U.S. still wields substantial influence when it comes to the institution. President Trump really tried to use this speech to tout his own economic policies. That's how he started talking about domestic manufacturing and his tariff deals, calling this the golden age of America, and then using that to try to draw what he would say are stark contrasts to other countries really abandoning any calls for unity. John, I do think it's worth pointing out, though, that President Trump did meet immediately after face-to-face with the UN Secretary General, and he told reporters, President Trump did, that while he often disagrees with the UN, he still stands firmly behind it.
Tyler Kendall with the latest. Tyler, thank you, here in New York City following developments over at the UN General Assembly. Could this all have been avoided if the escalator worked properly? Could we have avoided this?
Not just the
Put in the prompter,
escalator.
the
How
escalator.
did the teleprompter not work? I mean, this is the President of the United States, and the escalator is literally working 2 feet before.
Just as he steps on it.
As he steps on. So it is curious, and Caroline Leavitt shared a screenshot.
Came out swinging, yeah.
From the Times of London that said, individual at the UN, we're talking about, well, maybe what we'll do is do something with the president comes, like shut off the escalator. Was that a joke, or is this for real?
Yeah, maybe if they hadn't done that, he would have come out and said, kumbaya. Let's all just get behind the UN.
It's a joke, Bramo. It's just a joke.
This is the President of the United States. It's really embarrassing for the United Nations.
I have to agree with you, by the way.
It's embarrassing.
I totally agree with you. Joining us now to discuss not that, but everything else, Ed Mills of Raymond James. Ed, welcome to the programme, sir. I want to pick up on one line from the President. There was a few, but I want to pick up on this one. The suicidal energy ideas that will be the death of Western Europe. Now, it might be easy for some people to dismiss that, but we had an auto analyst on about 60 minutes ago, paraphrasing here, who essentially said the suicidal energy ideas that are killing the auto industry. Now, Ed, does the President have a point?
Well, I think what I've seen from the President is a strong support of traditional hydrocarbons. We look at the reconciliation bill that passed a couple months ago that repealed a lot of the Inflation Reduction Act, the green energy provisions. So this is very on brand for him. When we go to Europe, he was very critical of the oil and natural gas that was coming from Russia into the EU. And when we look at these trade deals, he's looking to make sure that Europe buys our energy resources, have the globe buy our energy resources. In his mind, providing U.S. energy is equal to providing U.S. defense support. So I'm not terribly surprised by that. And I guess finally, I think he is also very concerned about the Chinese, German kind of car auto partnerships. And he does not want to have supply chains going from Europe into China and then losing the industrial capacity of Europe. Those are really important for our NATO allies and our alliance. We need to make sure that industrial capacity absolutely remains in Europe, John. And so I think this is kind of very consistent with what he's been saying for more than a decade.
Ed, also on brand, we hear the U.S. government is looking to take a stake at Lithium Americas. What do you make of this new round of state interventionism?
Well, I would look at the 232 tariffs, and I would always ask the question, all right, if we are at war with China, if we have another significant event where supply chains shut down, what are the things that we need? We do know that there was a huge concern about the lack of critical minerals, rare earth minerals, that China has a near monopoly or a monopoly on. And we need to produce that here in the United States, or we need sources that are not from China. And so I think this is just the beginning. We've had, kind of MP materials. We've had Apple invest in their own supply chain. We're going to have this investment. We're going to see more and more of this because we are getting some of the domestic use of these, or kind of availability for domestic production, but we don't have availability for military production of a lot of these rare earth and critical minerals. And that's a huge national security issue that is kind of bubbling below the surface here in D.C. and is a huge priority that only kind of gets more attention as this develops, Annmarie.
Is the national security concern bigger than the concern that most conservatives for decades would say that this creates market dissertations?
Yeah, I mean, it's a very different world when we look at kind of the stake by the U.S. government in Intel, the kind of partnership with NVIDIA potentially providing for 15% kind of royalties. I've been kind of talking to clients at Raymond James, kind of this week, and this is a question and a theme that comes up. They're asked, all right, is it a good thing to kind of invest along with the government? Is this something that we have to look for more and more? There's an uncomfortability that I find with investors. But so far, because they are national security related, and these are areas where probably the private market does not operate on its own, they're okay with it. They probably prefer to kind of have the subsidy rather than the co-investment because of the traditional kind of barrier between commerce and the government. But this is Trump's style, and so far, he's going to kind of continue to push for this. I don't see a lot of opposition, especially when the dollars come with it, Annmarie.
Ed, do you expect to understand the frameworks of some sort of sovereign wealth fund in the near term that could potentially guide some of your clients a little bit better?
Yeah, potentially. I mean, one of the questions comes is like, all right, so when we have the stake in Intel, when we make these investments in these companies, where does the money go? To have a sovereign wealth fund, you do need a legislative vehicle that officially creates that. When we've had different investments in companies previously, usually, look back to the global financial crisis where we made investments in the auto industry, obviously investments in the bank. When there are profits from that, that just goes into the Treasury General Fund. So it's hard to account, especially when you have a debt and deficit as high as we do, for the actual return on these things. So if we have a sovereign wealth fund, if we have a guiding principle, maybe we get a better understanding of what that is. But I'm still waiting on that legislation, Lisa, to occur. It just hasn't happened yet.
Ed, you're one of the best. A clinic as always. Thank you, sir. Ed Mills there of Raymond James. I know some of the policies are polarising. That's politics. It's often the way. But I agree with Rick Reader of BlackRock. This is probably the most interesting time for investors, like ever. And he said it based on his career, that it's the most interesting time for him ever in his career.
Do you think he's going to be the next Fed chair?
I've got no idea.
Are you going to be the next Fed chair?
If he becomes the next Fed chair, things get even more interesting for me.
Yeah, that's right.
Okay.
Oh, is that an endorsement? I think that was just an endorsement.
No, I don't
Rick,
think it was.
Come on and talk about it.
I don't think it was.
Okay.
We're not doing endorsements here. But if he gets it...
then come on.
From New York City, this is Bloomberg. Equity futures on the S&P positive here by 0.2% on the S&P 500. Pulling back in yesterday's session, break-in. Snapping a 3-day winning streak on the S&P. No drama this morning, up by 0.3 on the Nasdaq 100. As we count you down to the opening bell, about 2 hours away. Let's get you some single names, some morning movers. Let's cross over to Danny for more. Hey, Danny.
Hey, John. It doesn't matter whether it's a U.S. AI company or a Chinese one. If you spend more on AI, you get rewarded. And that's the case with Alibaba. You're looking at the U.S. ADRs this morning, with the CEO saying that they will be spending more. The original target was for $50 billion over the next 3 years. The CEO says that they need to keep up with the trillions that are going to be being spent by this industry over the next few years. So those shares up 9.1%. Elsewhere, a little bit of sell-side action. Amazon getting an upgrade this morning. So those shares up by 1.4%, with the analyst there saying that their AWS is going to be looking better than expected, with a growth of 22% in 2026. The expectations had been for something that looks more like 18%. Their price target now implies a 27% upside on the current Amazon price. Still surging this morning is Lithium Americas, with the Trump administration reportedly looking at converting a $2.3 billion loan from the Department of Energy into a 10% equity stake. They're specifically looking at one of their mines in Nevada, to which the loan is also held, an interest is also held with GM. They were looking already at restructuring that loan. So you see GM shares also rising in sympathy with Lithium Americas, who, by the way, put out a statement just in the past hour, just confirming that they were indeed talking with the Trump administration. So those shares up just under 69%, John.
So basically, anyone in line for a loan approved by the Biden administration, is everyone just going through those names, seeing if they're listed and just buying those stocks now? Has that been the last month?
That's actually very smart. I think you should make an ETF for that.
I'm sure someone already has.
I'm sure that someone has.
On our radar this morning, Fed Chair Jay Powell reiterating there is no risk-free path to rate cuts, saying labour market and inflation outlooks create a challenging situation. This after newly minted Fed Governor Stephen Myron called for aggressive rate cuts. Elsewhere, President Trump believes Ukraine can reclaim all of its territory from Russia following a meeting with the country's leader, Volodymyr Zelensky. Trump also saying NATO members should shoot down Russian aircraft that enter their airspace. And finally, let's get back to that story. Lithium America soaring on reports that the Trump administration is seeking up to a 10% stake in the company. The news coming as the White House negotiates loan terms for the company's lithium mine project in Nevada.
Look, this is something a lot of people have talked about, especially after U.S. auto manufacturing basically ground to a halt when the U.S.-China trade relationship soured to a really difficult degree. It is clear the U.S. is reliant on China for some of these precious minerals. And at that point, how do you become self-reliant? You can say whatever you want, but there seems to be some sort of backdoor sovereign wealth fund that is emerging from the United States. And one thing that a lot of people want to get their heads around is what are the contours of that sovereign wealth fund? How big is it? How far is it going to go? And how do people get ahead of it?
And this all has basically the U.S. administration talking about the fact that they care more about national security than they do about basically if they look like they're having state capitalism right now. And this intervention is because when you look at the companies they're going after, it goes back to the raw materials. And what we had the past few days is a group of lawmakers in Washington go to Beijing, and they ended with a press conference saying this is one issue that's not resolved. And it is the rare earths and raw materials that the entire world basically just depends on China. So for the United States, this administration doesn't like grants. They don't like the loans from the Biden administration. So they're like, we're going to do something different. We're taking 5 to 15% stakes in these companies that we think is so important to our domestic critical infrastructure.
I think we're all sympathetic with the aversion to central planning. I'll leave that there. When it comes to this particular problem, though, when we spoke to Citi about 60 minutes ago about what was happening with Europe, he was pointing to the US, at least on a number of issues. They're listening to where the consumer is right now, the kind of things that they're buying, and the automakers are responding accordingly, and the government is giving them space to respond. In addition to that, lithium, we need to secure some of that. They're doubling down and making sure that we have access to those things. All these things happening in America that would arguably help some of these automakers. And I know there's other issues with the tariffs that are hurting them. I know there's other issues with immigration that might be hurting them. But on a number of issues, it's helping them. You're not seeing it take place in Europe.
This is the reason why there was this question, is the European auto manufacturing sector viable right now for an investment? And the answer is unclear. I think that longer term, there is this feeling that the U.S. doesn't have the luxury, and nowhere has the luxury of just standing still. that inaction is a decision, and it isn't one that people want to be taking at a time where the global order is shifting. And I think that is what's being recognized in the U.S. Too much controversy, but maybe is a question of how quickly can other places do something similar.
I'm sure they'd just love some cheaper steel now on top of everything else, but that's a different story for the US automakers.
That's true.
Lithium Americas up in a pre-market by about 70%. Let's turn to the equity market. Chairman Powell weighing in on valuations.
Equity prices will move up and down, and we do monitor that, but we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. By many measures, for example, equity prices are fairly highly valued.
What a run we've had for the equity market. 28 all-time highs on the S&P 500, and the rally just keeps on climbing. Rick Wurster, the president and CEO of Charles Schwab, joins us now to discuss. Welcome to the program, sir. It's good to see you.
Thanks, Jonathan. Nice to be here.
Welcome back, Rick. It's always good to see you. What a year it's been already for 25. Still got 3 or 4 months left. Can you frame for us how engaged your clients have been over the last year?
Our clients are very engaged. Our trading activity this year has generally been about 30% higher than last year. So clients are in the market, they're invested. I've been in about 15 of our retail branches in the last couple of weeks, and I was in Princeton, New Jersey yesterday, and I asked a client how they were feeling. And I think they synthesize what our investors are feeling really well. They said, I'm happy, but I'm nervous. And they're happy because markets are at all-time high. Their balances have never been higher, but they're looking at valuations and wondering, am I going to be okay? So it's a great time because they're looking to us for advice, and they're coming in and they're talking to us, and they're hearing from our experts. But it's, overall they're happy because markets are up.
What do you think the dominant anxiety is at the moment? We've been trying to ask this question. Is it the anxiety to get out? Do you have to do some hand-holding? Or is it the fear of missing out? Are they looking to lean in a little bit more aggressively?
I think our clients are generally engaged and invested. So I think it's more, hey, I have more wealth now than I anticipated. Markets have done better than I thought. Do I need to be worried about valuations, and should I be getting out? I think, interestingly, as it relates to the bond market, we're seeing a lot more interest in bonds now because with rates coming down, investors are wondering, do I need to go out the curve? I've been living off my purchase money fund, but the yields on that are coming down. Do I need to go out the curve and lock in higher yields? So that's been a topic of hot debate among our clients as well.
The sort of elusive money on the sidelines that we talk about that's supposed to rush back into everything else, particularly the long end of the yield curve. Is that actually happening?
Well, I think if you look at our clients, the percentage that they keep in either cash or purchase money funds has stayed relatively stable. Now, when the dollar amount has grown because their wealth has grown so significantly with the market increase in the last couple of years. So from a dollar standpoint, there is a lot of cash sitting on the sideline. But at the same time, it's roughly the same percentage that they've always kept because they want it for safety needs or they want it to, they're purchasing a house, whatever it may be. So I don't see a big story around cash sitting on the sidelines at the moment.
Do you notice a really big difference in how your clients trade depending on their age, depending on their generation? For example, older individuals tend to go to mega caps, younger individuals just straight Bitcoin.
Wow. We spend a lot of time talking with our younger investors, and we have 35 hours a week of live education and training to try to get investors to think about the difference between an equity and a coin, and to make sure they're making the right investment decision for them. I do worry about younger investors. And, crypto has been something that's done exceptionally well. But we want to make sure that young investors also know about the power of equities over the long term. And that investing generally is something that you want to do for the long term. Certainly you can trade and take on positions, but you shouldn't expect quick hits all the time. And I think we want to make sure that young investors are aware of that.
But I really appreciate in this country the bias to invest, the bias to act, the bias to take a bet. In the UK, I saw some numbers recently about how much consumers were investing, but how much of it was just going to really, really low yield stuff, like cash funds, stuff like that. There isn't the same bias to invest in equities and risk that I've seen growing up in the UK that exists here. Where do you think that comes from in America, and how do we continue to nurture it?
Well, I think it's great, and not only has it been great, it's getting even better. If you look at millennials, they're 40% more likely to be invested by the age of 21 than Gen Zers. So it's happening with younger investors as well, and we're trying to engage them where they are. We go to YouTube, TikTok, Instagram, and we put out videos about the power of compounding. And we try to get them interested in investing, because if you start young and become an investor, hopefully you'll stick with it and you'll build wealth. It's the single best way to build wealth in our country, is to be an investor. And young people today are embracing it far more than prior generations, which is outstanding to see.
It used to be that all those opportunities were in public markets, that you'd get that blockbuster IPO that you'd want to get exposure to. Now a lot of it's staying private. How are you thinking about offering opportunities in private markets for customers going forward from here? What kind of things are they looking to do?
Yeah, it's an interesting question. There's a lot more private companies than there used to be, and fewer public companies. And so I do think it makes sense to think about providing direct access to retail investors to private companies. And that's something that we're looking at and thinking about how we participate in. But some of these companies are huge. You look at the Stripes, OpenAI.
500 billion.
Yeah, they're billion-dollar companies. And so I do think retail investors ought to be able to invest in them. And at the same time, there's probably people sitting at that company that would love liquidity for their stock position. So I think there's a market to be made there.
How much do you think that it's isolated in companies versus real assets? And I say that at a time when we're talking about the reindustrialization of the United States and the idea that there could be actually some oomph behind it for the first time in a long time. I mean, how much is that part of what you're looking to give access to clients?
Real assets?
Yes.
Well, I think real assets have been a great way to invest in our country. And the main thing we focus on is differentiating between productive assets and speculative assets. And I think real assets are productive assets. And so it's a great way for a client to get invested.
Are you concerned about, you keep talking about the coin and you're concerned about it, and actually the productive versus unproductive. Do you think that that's actually a point of concern right now in markets, the amount of involvement in the crypto space?
Well, I think crypto could end up being very, very valuable. And there's a role for it to play, and there's a role for tokenization and the blockchain. What's important to us is that investors, particularly young investors, know what they're investing in and know why it makes sense for them to be invested in it, and understand the difference between, say, an equity and a bond, which have some positive expected return and they're a productive asset, and just understanding the difference between that and a more speculative asset like art or baseball cards or crypto, where you don't know what the future return is going to be. It's not that we don't judge people's investments, and we can see a world where crypto is very, very valuable, but we want clients to understand the difference between those investments.
Do you think next year you're going to have more opportunities for either hiring or strategic opportunities because you think policy is clearer now out of Washington?
You know, what's driving our hiring is the growth of our business. We're growing at a really strong rate. We're seeing a lot of engagement from clients. Increasingly, they want advice from us. They want our help in their financial life. And because of that's what's driving our growth. It's not about what's happening with policy.
Can I just finish on the potential for a partnership on private markets? I wanted to ask you that. Is that something you'd consider, a partnership with another firm to offer that kind of access?
I think we would love to see retail investors be able to participate in the growth of private companies in our country.
So would Apollo. I've heard the same thing from them. I'm trying to make a market now.
And we have we have KKR on, firms like KKR on our platform.
Yeah.
And that our retail investors can invest in. And that's a great way to get access to private markets. They're experts. They started the market. They've been in it forever. That's a very thoughtful way for our investors to go be a part of private markets.
Seems like this is the direction of travel, at least for retail.
Well, and it seems like the regulatory landscape is opening up to pave the way for that. And the question is just what form that will take, and whether private markets are the new public markets, whether there's any difference, like Apollo has said, maybe not. And this is sort of the new path ahead for a lot.
Are we mediating? Trying to broker a deal?
I think that was a good try, by the way. Rick really effectively navigated that.
Rick, appreciate your time. It's always good
nice
to
see you all.
Thanks for dropping by. Thank you, sir. Rick Wurster, the Charles Schwab CEO. If you are just joining us, equity futures on the S&P positive here by 0.1% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yohara for more. Hey, Yohara.
Hi, John. Micron shares have now turned lower in the pre-market, down 1.3%. That's despite the chipmaker topping revenue estimates for the current quarter due to high demand for its AI hardware. The outlook validates the idea that Micron has become a key beneficiary of AI spending due to its high bandwidth memory products. Micron said it expects supply of memory chips to remain tight into next year. But as I said, shares are lower. Meanwhile, the Bloomberg Philanthropies Global Forum takes place today alongside the United Nations General Assembly here in New York. The event, hosted by Michael Bloomberg, brings together top leaders, including the ones you can see behind me, from the public, private, and nonprofit sectors, to address the world's most urgent challenges and opportunities. You can tune in starting at 9:15 a.m. Eastern. And the Ryder Cup opening ceremony has been changed to today at 4 p.m. Eastern. It was originally scheduled for Thursday, but was moved up because of inclement weather in the forecast. United States captain Keegan Bradley and European captain Luke Donald will still announce the Friday morning foursomes pairings on Thursday. So we will have to wait. That's your Bloomberg Brief. John?
Looking forward to that one, Yahara. Thank you. Up next, passing on tariff costs.
There's a lot of uncertainty about the direction of public policy, and so companies are holding off. That may be a way of passing on tariff costs. The pass-through to consumers has been later and less than we expected.
Up next, Russ Brownback of BlackRock, live from New York City this morning. Good morning. You're watching Bloomberg TV. Equity futures on the S&P, positive here by 0.1% on the S&P 500. On the Nasdaq, up by 0.2. In the bond market, Treasuries stabilised at the front end of the curve on a 2-year bond yield this morning, around 3.57. On 10s, around 4.11. Under surveillance this morning, passing on tariff costs.
There's a lot of uncertainty about the direction of public policy, and so companies are holding off. That may be a way of passing on tariff costs. It is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. The pass-through to consumers has been later and less than we expected.
So here's the latest this morning. Fed Chair Jay Powell calling the current environment a challenging situation with risk to the labour market and inflation. Russ Brownback, the Deputy CEO of Global Fixed Income at BlackRock, joins us now for more. Russ, always good to catch up with you.
Morning.
Thanks for being here. How are you capturing the division at the Federal Reserve and thinking about how to apply that into ideas to invest in fixed income?
Yep. So we agree with where the markets are pricing forward Fed policy rather than the dots. We've talked about in previous appearances here, we talked about the suboptimality of the policy setting today. And, we look at an economy that's doing fine. If you look through the noisy GDP measures, you look at gross domestic income, you look at private final demand, it's humming right along at 2%. But beneath the surface, there's dispersion. Millions of low-income, low-wealth households suffering from floating rate debt, all the credit card debt, all the auto loan debt, student loan debt, and small companies, which employ 40% of the people in the labor force today. That's where the floating rate debt is. And the housing market is really suffering. I mean, the turnover in the housing market approaching, sort of GFC kinds of levels today. And so that policy setting today, while not, denting the overall economy, is my analogy is it's like you can run your car at 70 miles an hour if you have 3/4 tire pressure, but your fuel efficiency is not optimal and your ride isn't as smooth as it could be. Why not pump the tires all the way up to full pressure and have a better ride?
So pumping up the tires is what? Cutting interest rates by another 50 basis points?
So listen, I think, I think there's too many modern, contemporary influences today for anybody to have a real guess at what neutral is. But a 4 handle on the overnight rate, when forward inflation markets are telling you inflation's headed to the low 2s, is too onerous. And so I think ultimately, as the data unfolds, it will become clear that the Fed can deliver what's priced.
If you have a smoother ride, you can go a lot faster. And that is one concern. If you cut rates to smooth the ride, I'm really going far with this analogy. I think we can stop it here. But I just am wondering how much this actually makes you not want to invest in the long end of the yield curve.
So I don't think there's dissonance between the idea that the Fed can be easing at a time when the economy is fine. I don't believe we live in a secular disinflationary environment. We lived for a decade into the pandemic with too little inflation. The central bank was fighting inflation from beneath. I understand the scar tissue from what happened in the pandemic. When you pump $5 trillion into the bank accounts of the private sector at the time that the supply chain is shutting down, you get too much money chasing too few goods. That's inflation. You need to lead against that. They did, but they've wrung that out of the system today. If you look at core PCE on a trailing 3, 6, 12-month basis, 2.5 years, it looks like a black diamond ski slope coming straight down. That descent has slowed because tariffs are making goods prices tick up. But when you move goods prices up one time, that's not inflation. Inflation is a recurring phenomenon where goods get marked up, people pay more, then they ask for higher wages and so on. That's not what's happening today. You've got price stability, which is actually the Fed's mandate. You look at the volatility of inflation. One last statistic I'll give you. We measure the variability of the rate of change of a $100 basket of PCE consumption items. Over the last year, that's 37 cents. 2 years ago, that was $3. So the Fed has won the battle of price stability.
So aside from running for Fed chair yourself, I am wondering going forward whether this just means that you're going to invest wholesale in duration at this point, given the fact that right now there's a lot of concern in markets about a very different view than what you just put out there.
So it's a great question. The markets, though, have priced the view that I just laid out. And so
that's fully priced.
So we think that the yield curve is kind of in equilibrium here. As I've said before, the front end's anchored to Fed policy. The longer end sort of gravitates toward nominal GDP outcomes. So in the fixed income portfolios today, we don't see a big directional trade in rates. We've called it the golden age of income. It's about just harvesting the yields today that sit so far above inflation.
You sound like you're talking about a productivity boom next year. And I'm interested because we're going into a midterm election where most polls continuously show that Americans are concerned about inflation. Even if it's a one-time price adjustment, it is still going to be higher in terms of cost of goods? Or do you think corporate America is going to absorb as much as they can?
So I think sometimes, these surveys probably capture sentiment about high prices as distinct from inflation. We have inflation that's come all the way back down into the two. It would be in the mid twos if it weren't for tariff increases. So when people are talking about, trading down from hamburgers to hot dogs, it's in deference to high prices, not inflation. So I think that's conflicted in the surveys. Productivity, we, after a decade of a productivity bust, we're looking at 2% productivity today. Think about what that means. It means you can grow the economy at 2% real without adding 1 minute to the hours worked during the work week. And there's many prognosticators that suggest that's going to be inflecting higher still to 3 or 4%. I happen to be an optimist in that regard. So I think you can have your cake and eat it too.
Russ, I want to finish on this. Something that your colleague, our friend Rick Reeder, has said recently. Said it a few times. This is the most interesting time for investment that he's ever seen. I imagine you agree with that. What's so fascinating about this moment in time?
So worked with Rick for 33 years. We've seen all the ebb and flow of everything. About a decade ago, we stepped off the efficient frontier of unbridled globalization. You've got generations worth of norms in geopolitics, in trade, in fiscal policy, in monetary policy being shattered. So that creates moments and bouts of uncertainty, but that's what we live for in markets. When you get the dislocation and you can go in and tactically trade around that, that's nirvana for us.
Russ, it's good to see you. Thank you, sir. Russ Brownback there of BlackRock. I couldn't agree more. All these different things happening. Don't follow the VIX. That kind of buries the story. You've got all this volatility elsewhere to take advantage of.
There's sea changes in technology, sea changes in trade flows, sea changes in just demographics and how much people are aging and how they're investing. And I just am really stuck on the idea of trading down to hot dogs from hamburgers. That made me a little sad.
That is sad, isn't it?
I hope that that's not happening because I personally...
No, that's real.
But that is real. And that's
people,
so there's also that
real.
issue and how you actually factor that in as well. Not to bring it to that, but I have to bring it to that.
OK. Coming up on the programme, Darrell Cronk of Wells Fargo, Greg Tuorto of Goldman Sachs, Nathan Sheets of Citi and Vichy, Tirupattur of Morgan Stanley. All of that in the third hour of Bloomberg Surveillance. Up next.
The key driver of this bull market has been AI and tech.
We're becoming still very dependent on a smaller handful of stocks.
As investors, what we need to do is separate out what is the medium-term trend from the short-term cyclical trading trend.
Next year, we do see earnings improving 10%.
We have Q3 earnings coming up. We don't have a beat and a raise. I think you will see a pullback in the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell, live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P 500 just about positive by 0.2%, bouncing back from yesterday's losses. Some big AI spending plans we can talk about in just a moment. The Nasdaq up by 0.25%. In the bond market, light on data through to Friday. Looking for jobless claims tomorrow on Friday PCE. Yields down by a basis point at the front end, 357, up 2 at the long end, 412. The curve steepening somewhat. Going into that data this week, Thursday and Friday for claims and PCE. In between, tons more Fed speak. And look out for Costco earnings too, just to get a flavour of where companies are at right now and their ability to pass on higher costs.
Yeah, yesterday in the PMI data that we got out of the United States, there was a sense that maybe companies were having a harder time passing along those costs. So maybe this is actually a positive signal when it comes to just how much inflation can accelerate, albeit maybe less positive for margins. That said, the likes of Costco, the likes of Walmart, the likes of Home Depot, how much are the giants in the retail space consolidating market share with efficiencies of scale, with efficiencies of technology that put them in a different realm? And that actually is also what I'm listening for.
They should just announce some big AI spend. If Bloomberg Surveillance was a stock, I'd be announcing an extra $10 billion this morning. Alibaba up by 9% in the pre-market after announcing they're going to spend more on AI.
Yeah, maybe you could just say you're replacing me with an AI bot, and all of a sudden the shares would go.
That stock,
oh,
Grandma.
Oh, that's so sweet. Look, yes, we have seen a huge. I'm going to move on because I was just so touched. That's so sweet of you. I am thinking that this is something that the market is endorsing, these spending plans for artificial intelligence, and that ultimately will be a self-fulfilling prophecy until it isn't. It's sort of the Dan Greenhouse school of thought that it can be a bubble, but you still want to keep buying until you don't, and then you don't want to be buying, and that's sort of what AI investment plans have looked like.
This circular trend on the way up, it feels great. It makes a lot of sense. But the way down, how big is that downside? Could it potentially be? But this number, and you mentioned it a few times, Jonathan, this morning, when you have the CEO of Alibaba talking about overall investment in AI, $4 trillion worldwide over the next 5 years, and Alibaba needs to keep up. And now you see just the absolute arms race between Beijing and Washington.
I think Tchir of Academy was great earlier this morning. He talked about the difference between early innings and late innings. The spending plans are early innings. The valuations are late innings. That's the problem market participants have got right now.
Yeah, but not end inning, right? So at a certain point, you might bring it all forward and then look at the percolation of those investments into the rest of the sphere. This is a very difficult thing to really get your hands around on any level. The one quote that I keep thinking about is when Microsoft and Meta were saying that the risk is not investing enough, not investing, it's not necessarily investing too much. And that is clearly what we're seeing across the entire industry.
How many innings are there?
9.
How many are there? There's 9?
No, it depends.
It depends?
Extra innings.
Yeah, there could be extra innings, but overall,
Okay.
let's say
Don't worry.
9.
You really wanted to start this conversation?
Yeah, I just wanted to have
Well, yeah,
that
because the
debate right
Yankees are now in the playoffs.
You want to squeeze
so
that in?
I just had
And
to
the
say
Mets,
it.
what's happened to the Mets?
Mets are Metsin.
All right, this is good. Okay, coming up on the programme, Lisa might be gone. Darrell Cronk of Wells Fargo on the latest AI spending plans. Greg Tuorto of Goldman Sachs Asset Management on the small cap breakout. And Nathan Sheets of Citi Global on a divided Federal Reserve. We begin this hour as Alibaba becomes the latest company to ramp up AI spending plans. Darrell Cronk of Wells Fargo writing, "We are closer to the beginning than the end of a new capex super cycle. The additional power and energy needs alone to fuel the AI revolution may be the largest constraint." Darrell joins us now for more. Darrell, good morning.
Good morning, John.
Are we going to keep on rewarding these companies making these big announcements?
I think in the near term, yes. I mean, I don't see any slowdown to that. I mean, quite frankly, I think the Alibaba CEO with his comment this morning might be light on the $4 trillion. I mean, there's a lot of estimates out there that it's actually $6 to $7 trillion. And in fact, if you take every dollar spent on just AI alone, it's estimated there's probably $3 to $4 needed to be spent on the infrastructure to support that AI, right? So if you don't want to own and pick the next winner in the race, right, who's going to win that ultimate AI race, you own the picks and shovels, right? You own the stuff that pulls into that, right? It's a safer play. It can be through the energy mix. It could be through data centers. It could be through utilities. Like, there's a number of ways to play that.
Well, there is a company that owns the shovels. It's NVIDIA. And now they're buying gold mines, or at least taking stakes in them. Isn't that confusing?
It is a little confusing, right? I mean, I don't know that that's where you need to be, but when you have that much free cash flow, you've got to do something with it, right? And so I think you're going to continue to see that trend. I think what people miss here is you talk about these big seismic trends, in history, industrial revolution, the development or birth of the internet, all that stuff. It's when founders and disruptors show up at the same time and they collide and they change the landscape, right? And I think that's a moment that we're in. So we can look at the stock market and say, look, the market has lived since April without more than a 2.7% S&P correction. The longest duration of that correction is 4 days. We're a little exhausted. We're a little tired if you look at the advanced decline line. Like we can move sideways. But I think if you back out and see the secular trends that are at play, I think that's what's important here, right? It's the super CapEx cycle. It's the AI revolution. It's the onshoring manufacturing renaissance. It's deregulation, right? It's all these things happening simultaneously that I think are a powerful concoction.
I think what Pete Tchir was getting at is everyone's stepping back. Everyone's appreciating the awe of this moment and valuing it very highly without getting there yet. And even if we're in the early innings of the actual investment and the actual execution of this grand technology and technological disruption. So how do you sort of bridge that gap of valuation and everyone stepping back, appreciating the awe and not necessarily seeing it get done?
Well, for us in portfolios, we're on the wrong side of the trade the last 30 days of being unfavorable small caps, right? Which have been, ever since the Fed's going to cut interest rates and this is going to go wild. It's ironic. I was looking last night. So last year, the Russell 2000, $67 of earnings, right? This year, it's on track for $72 of earnings, $5, so call it 7%. Next year, $102. That's a 42% increase in earnings by Bloomberg's own estimates of what the street has. No way. No way. I mean, you're not getting that out of small caps, next year. So I think to answer your question is, you can still play this trend in a number of ways. Picks and shovels is one. You can go up market in quality and stay with a large cap where they are generating that free cash flow, where they are truly generating the earnings. I'd be really careful about the dash for trash right now. I think that looks overextended to us. Places where everybody just decided, okay, this rally's going to live forever, and I'm going down the quality spectrum. That just doesn't make sense to us right now.
So, and what you're discussing is something people have been debating. Do you stay with the high flyers, or do you look elsewhere? And you're saying you can look elsewhere, but be careful, but also stick with the high flyers. Is that kind of what I'm hearing?
Yeah, I mean, we're overweight tech in the portfolios, but tech is not a vertical, right? Tech is a horizontal now, right? It's touching every, obviously, sector and industry that's out there. So I think you can have that. We love financials. Our best idea is financials right now because, I mean, obviously, as the yield curve steepened, that's great for NII. There was no early signs of delinquencies, defaults, right? The M&A and IPO world is picking up. I mean, IPOs are up 63% year to date. M&A is up another 35% year to date, year over year on run rate numbers. I mean, that's all great for those types of industries. Industrials are doing well. Utilities are doing well. So everybody's talked about the equal weight S&P 500. I won't drain that, conversation again. But it is true, the breadth is expanding out, right, when you look at it. And I think you can own some really great companies at reasonable valuations here and not be afraid about chasing the uber high valuations all the time.
When you say sticks and shovels and you're looking at potentially the AI build out, are you looking at companies that have a loan or a grant from the U.S. government because you think this administration is going to take an outright stake?
You can, but I would still, that's where I would go back, Annmarie, to the fundamentals. I'm not sure those are the greatest fundamental companies. There's a reason that equity injection is coming, right, for the support and the cornerstone of the industry. I would still look for companies that could do it on their own, right, and not necessarily need that type of support in the equation. It is odd that we're doing it through equity. Right? I mean, history tells you there's examples where that's come through loans and debt and other ways of repayment. The true equity stake in those core industries, I think, is a little bit of a game changer.
Do you think this could distort the market, what the U.S. government is doing?
I think the only way it really distorts the market if there's an in and an out and an in and an out, and it's very episodic, right, in the way it's done. If it's a true, sustainable, long-term investment, probably not, other than the moment in time that it's announced. Right?
They are attempting to backstop the Argentine market right now, so I'm going to bring you some breaking news from the Treasury Secretary, Scott Bessent, just moments ago. The Treasury is currently in negotiations with Argentine officials for a $20 billion swap line with the central bank. We're working in close coordination with the government to prevent excessive volatility. The Treasury Secretary going on to say, in addition, the United States stands ready to purchase secondary or primary government debt. And we are working with the Argentine government to end the tax holiday for commodity producers converting foreign exchange. The most effective backstop, the best kind of backstop, is one you don't actually have to use. and we'll see what happens next with this one.
Yeah, especially given that this is almost a threat to what Scott Bessent, Treasury Secretary, calls the speculators, and that Argentina has all of the tools to defeat the speculators. Is this something that will get called upon, or is this the vote of confidence that Javier Milei needed, especially given some of the recent losses in recent elections?
Absolutely. We're going to, I think, know at the end of October whether or not this worked or not, at least politically, to backstop Milei and his government when it comes to really tough race in terms of the austerity measures he has put in place that are now starting to backfire a bit politically.
This, of course, is very different, but I always remember what Mario Draghi did in the Eurozone debt crisis when he first took over and came up with the unlimited bond buying plan, which eventually was known as OMT. I think it was outright monetary transactions or something like that. It was so effective that he never had to buy a single bond with it. It was a plan that was never activated, and it scared the speculators off. Imagine for the Treasury Secretaries coming up with a plan that you don't want to be on the other side of at the moment, and we'll see how effective it is for the weeks and months to come, because it's not just about getting through the next couple of days. It's providing some longer-term stability.
Yeah, and Argentina has an unusual amount of hair on it, considering the fact that it's defaulted on its sovereign debt 9 times.
You bring the bazooka, right? That's.
Do you think this is the bazooka this morning?
I think it is, because, again, to your point, you want to make a big step in there. And remember the old adage about financial markets stop panicking when central banks start panicking, right? So when you bring the bazooka, it usually means central banks are engaging, and that's when financial markets usually make that inflection point.
Darrell, it's good to see you. Thanks for dropping by. Thank you, sir. Darrell Cronk there of Wells Fargo. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. During a meeting with Ukrainian President Zelensky at the UN, President Donald Trump said NATO nations should shoot down Russian aircraft that violate their airspace. Separately, the president saying on Truth Social that he believes Ukraine can win back all of its territory from Russia. He also said Moscow is fighting aimlessly, calling the country a paper tiger. Meanwhile, President Trump has canceled a government funding meeting with Democratic lawmakers. It comes as a shutdown deadline is just 1 week away. Trump stated he wouldn't meet until Democrats become realistic with their demands, which currently include extending Affordable Care Act tax credits and rolling back some of the president's earlier policies included in his big, beautiful bill. And OpenAI is expanding its data center push under its plan dubbed Stargate. It plans to invest about $400 billion to develop 5 new U.S. data center sites in partnership with Oracle and SoftBank. This marks its biggest push yet to fulfill an earlier pledge to spend $500 billion on AI infrastructure in the country. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, the Morning Calls, plus Greg Tuorto of Goldman Sachs Asset Management on the small cap breakout. That conversation up next.
Our trading activity this year has generally been about 30% higher than last year. So clients are in the market, they're invested. They're happy because markets are at all-time high. Their balances have never been higher, but they're looking at valuations and wondering, am I going to be okay? I don't see a big story around cash sitting on the sidelines at the moment.
Charles Schwab CEO Rick Wurster joining us in the last hour or so. Investors have re-engaged in such a massive way post-April. Now we're looking for corporations to do the same going into 2026 and hopefully start to stimulate this economy. If you are just joining us, welcome to the program. Equity futures on the S&P 500 firmer here by 0.1%. On the Nasdaq up by 0.2. For the small caps, the Russell up by 0.1. Also, that's the price action. Let's get you some morning calls. First up, Bank of America raising its price target on Alibaba to $195 as it increases its investment in AI, seeing it as the world's leading full-stack AI services provider. Your second call from Wells Fargo upgrading Amazon to overweight, expecting greater conviction in the Amazon Web Services division. And finally, UBS upgrading General Motors to buy holding, an above consensus view for its North American margins. That stock is up by 2.4%. Let's stick with equities and turn to the Russell 2000, seeing all-time highs as the stock market rally broadens into small caps. That index has rallied more than 13% since the beginning of August. The moment we had that payrolls report for July, this stock market has taken off as it reprices what's going to happen with rates and ultimately what that means for small caps. Joining us now to discuss is Greg Tuorto of Goldman Sachs Asset Management. Greg, good morning, sir.
Thanks for having me.
It's good to see you. We've seen a few head fakes for small caps before. A lot of people are conditioned by that. How do you understand the difference between a head fake and a real deal, something more sustainable?
Yeah, I think the backdrop, especially the economic backdrop for small caps right now is probably the most transparent it's been in that 3 or 4 year time frame since we had last record high. The financial conditions index, which is really important for small caps, is quite easy. We know we have a couple of more rate cuts in the offing, and if you look at some of the bottoms-up indicators for the economic activity, we're over 3% for GDP growth in the third quarter, which is well ahead of where the sell-side economic forecasts are. So those are really, really good, and I think that people have wanted to see it before they place their bets, and I think that's what you're seeing right now in the marketplace.
Well, some people are worried that this is a K-shaped economy. There are a lot of people who are very much feeling the inflation that has been percolating for the past 5-6 years. People are definitely having a harder time and feeling less confident about the labor market, and that small caps are disproportionately affected by these trends. What's to say that's ending in enough of a sort of groundswell to give support economically, fundamentally to these smaller companies?
Well, I think you have seen some of that, transposed into the market, especially in like the restaurants sector. It's not done well, especially in the last month or two. August and September have not been good for that space. You're seeing a little bit of a wobble in some of the retailers, especially at the low price area. So I do think there are some consumer-driven parts of the market that may not be in the best shape. However, some of the things that you see that are CapEx driven, especially we heard from Micron last night that they're going to spend more money. They need to spend more money. That translates into a lot of, kind of opportunity for small cap companies. There's a lot of companies out there that have that either direct or indirect benefit from their capital spending that we hope to take advantage of.
Do you think that the Russell 2000 as an index is the best representation of the story that you're telling? Or do you think that it's other indexes that have different cohorts of companies that might be smaller or mid-sized, but that the Russell 2000 has a number that have been left behind kind of, and that haven't done as well for a long time, which is why they've remained in sort of the smaller bucket?
A lot of interesting thoughts came into my mind with that question. I do think that there are some construction issues with the Russell that have gone on over the course of the last few years that have brought in some things into it that that are not representative of what we're talking about. I do think that in terms of just talking my own book, which I know I am, the active manager in the small cap space has a significantly larger menu to choose from to kind of weave inside and out of those things. Think about the biotech space. The biotech space in 2021 compared to today, you have to be so much more selective, but you can find some really good opportunities. If you just bought biotech or biotech in the Russell 2000, you're taking a lot of chances there, and I do think that's the difference. As the Russell 2000 has tried to cast a broad net to do these things, it's kind of caught some things it probably didn't want to catch.
Where else do you see opportunities outside of biotech as one?
Yeah, biotech's one. I mentioned semi-cap equipment, as an area, especially after what Micron talked about. I think medtech is starting to reemerge. I've talked about it for a while, but I do think that outside of some of the areas in medtech, you haven't seen a lot of life in healthcare. Healthcare has been tough. I think the S&P 500 healthcare got to its lowest level in decades, and I do think medtech is starting to see some recognition for the growth that it has, which is well above kind of the last 3 or 4 years, kind of moving towards mid-teens. Like that area a lot. Asset managers, just in terms of kind of what's gone on in equities, many asset managers are equity heavy. And then finally, capital markets banks. We like Piper Sandler a lot. In terms of its exposure to not just sort of what's happening in the equity capital markets, but also in the debt capital markets with their muni business.
How much M&A do you see in small caps?
It's starting to really pick up. I think it's happening in much smaller companies right now. I think it's because the private equity guys are so flush with cash and they're wanting to put things together. So you're starting to see a lot of $2 billion, $3 billion deals. More PE than strategic. The strategics will start to come, we think, as we get closer to the end of the year. I think that they've been waiting for this all clear along with us. Price plays a difference, and I think that you're starting to see price pick up off the bottoms, and that's when strategics start to kind of dig in, because they're like, yeah, I'm not going to get those bottom prices that I had hoped for, so I'm going to have to pay what the market's dictating.
Greg, you're super dialed in, focused on the fundamentals, and I respect you for that. I think a lot of people treat small caps differently, though. They treat small caps like they treat EM. It's like in and out and not for long. And I just wonder if it's the characteristics of the investments that drop in and out of the asset class, if I can call it that leads to these moments where we get these head fakes, these moments of outperformance that don't last long. Is the money typically faster that gets into small caps? What is it about those investors that play in that area of the equity market?
It's a great point, and I think that, I've done this for almost 30 years, and it's so if you think about the last 3 years prior to the prior 27 years of my career, it wasn't like that as much. I do think that there's been more transition both in and out of the small cap asset class, like you discussed, which has kind of caused some of that tourist action that we've seen. But I do think that you have a really good chance for both beta and alpha in small caps right now, which you may not have in some of the larger caps. People are very worried that the larger caps are expensive, and small caps are 25 to 40% cheaper with better earnings revisions characteristics right now. So they could be even cheaper if our 26 numbers are right.
And a million times smaller. I don't know by definition, but the very fact that the Russell's $3 trillion, and so is a single name on the S&P 500, isn't that dictating the style of investor that gets involved in your world?
It is. In some instances, you've seen a significantly larger, as the CEO of Charles Schwab said, kind of proportion of retail investors in this move, recently. But I do think it's not always consistent over cycles. I think they do find other places to go, especially when there's thematic opportunities in other areas. I do think that just some of the themes, whether they be artificial intelligence, nuclear power, quantum computing, have all been in the Russell. So it's really kind of, it's coalesced in there, and it's made it harder for active managers, but I do think it's more opportunistic going forward because there's some other things that are happening right now that we're getting excited about.
How many rate cuts do you need to stay excited about small caps in the next, say, 12 months?
I think you probably need 2 to 3 at least, which I think is, kind of in the priced in camp. If you got 4, I think which should bring you down to a nice healthy 3, right? I think that would be something that, combined with say a 2+ GDP, is sort of a, if I can use the term from earlier in my career, Goldilocksian type scenario, right? I think that's what we'd all hope for. You don't always get what you hope for, right? But I think that as directionally we're going in the right place with rate cuts, and the economy seems really, really stable.
It was nice to talk to you about small caps without talking too much about interest rates and the Federal Reserve, which is typically all it's about. Greg, it's good to see you.
Thanks for having me.
being here. Appreciate it. Greg Tuorto there of Goldman Sachs Asset Management, a clinic there on what's happening beneath the surface in small caps.
Yeah, at a time when a lot of people do think it's just an interest rate bet. I just am struck by how much energy has been put to some of the large caps, how wide open capital markets have been to them, at the same time that a lot of small caps are still looking to extend maturities and deal with their balance sheets, and that's one reason why it has been so tied to rates.
Lower interest rates helps a lot. We've seen a massive move since early August off the back of the repricing of the Federal Reserve. Coming up, we'll catch up with Nathan Sheets of Citi on a divided Federal Reserve. Chairman Powell trying to unite the impossible over on the FOMC. We'll get into the details of the Fed speak so far this week. In the equity market on the S&P 500, futures positive by about 0.2%. And in the bond market, bond yields just a little bit higher at the front end, 357 and up by 2 1/10 to 413. From New York City, you're watching Bloomberg TV. The open about 60 minutes away. Stocks are positive across the board, up by 0.15 on the S&P 500. On the Nasdaq 100, higher by 0.2. Let's get you some single names, some morning movers. With more, here's Danny. Hey, Danny.
Hey, John. Acadia Health to the downside this morning, down 11%. It's been jumping around, that despite the fact that Engine Capital, the FT reporting, taking a stake in the behavioral health company. Initially, shares were higher. They have turned around the point of this stake taking, according to the FT in a letter that they've reviewed, is they want to change some of their activities. They want them to review their portfolio, hold back on some of their capital-intensive projects, and rework this board. A little bit of sell-side action also moving things this morning. Adobe shares, those are also falling this morning, down 1.2%. Morgan Stanley downgrading the company to a hold, saying that some of its decelerating sales are a warning flag when it comes to their Gen AI, the promise of it and the ability for that to really generate a return. Those are the concerns for Morgan Stanley, so shares are down 1.2%. Elsewhere, we are looking at PayPal moving higher by 1.1%. This morning, Blue Owl affirming that they are taking a $7 billion chunk of their buy now, pay later assets. PayPal will continue to run the client-facing versions or the client-facing activities for those buy now, pay later loans, but it allows them to move more capital light. And it's a trend we've been seeing. Klarna and Affirm also have been selling some of their loans to non-bank entities. Blue Owl just up by 0.7% off the back of that. John.
Danny, thank you. Looking forward to the program. Open interest 30 minutes away with Danny and Matt. Look out for that a little bit later. Counting you down to the opening bell. Let's turn to the Federal Reserve. Fed Chair Jay Powell reiterating the challenging path ahead as policymakers weigh further easing. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. I think there are 3 points that people on Wall Street may not be getting completely. So let's go through those. When you look at the dot plot, you see that the Fed, when you compare it to the last time, the Fed has definitely moved down. But also look at, if you're looking at the white dots, look at the dispersion for 2026 and how much that has widened out if you compress some of those smaller, the individual dots in the previous forecast. What the Fed is telling you there, and what Powell was trying to say yesterday, is we don't know whether we're going to be able to cut rates and by how much next year because the economy is evolving in ways that we can't predict. So it's not that they're saying we're not going to do this. They're not saying we're going to do just one cut in 2026. They're saying that right now it looks like we know we could do that probably, but let's wait until we get all the data. Second thing is what the dispute between Stephen Myron and the rest of the board is all about is the neutral rate. What is R star? He's not out of bounds completely. If you look at the range of estimates from the September SEP, it was between 2.6% and 3.9%. He says he's in the mid 2% area, so give him credit. Could be 2.5, 2.6. He's at the bottom end, but he's not out of bounds completely. But the real issue is that, as Jay Powell has said many times, we cannot identify with certainty what the neutral rate is, and therefore he makes the case you should not make policy based on the neutral rate, whereas Stephen Myron says you should. That's what the dispute about at this point. And finally, one thing that hasn't gotten as much publicity that I thought it would yesterday when Jay Powell said, by many measures, equity prices are fairly highly valued. Is that an observation or is that a warning? We've seen that from Fed officials sometimes in the past. When rates, when levels get pretty high, they don't like to talk about the stock market, but in this case, he did. And then Alibaba today said, hold my beer in terms of pushing markets higher.
Well, precisely.
So we'll see.
Mike, thank you, sir. Appreciate it. Some rare insight, comments from the chair on valuations, and some people might just snap back and say, yeah, thank you. You're a big part of that.
Well, and it's only going to continue, right? I mean, to that exact point, I'm sorry, I'm distracted by this Oracle deal. I have to just mention it. Oracle is selling $15 billion of bonds, including a 40-year tranche. And they're looking for capital at 6.4%. That's the cost of it. For 40 years, for a company that is engaging in tech, why can they do this? Well, a lot of this is because spreads are so tight. Why are spreads so tight? Because the economy and the market is being underpinned by the Federal Reserve. So it raises this question of, are we getting over our skis or does it even matter? Because buy, and that's what everybody seems to be doing.
It's a K-shaped debt market. Not everyone has that kind of access in fixed income, let's put it that way. Let's turn to Nathan Sheets, Chief Global Economist at Citi, writing the following. US firms appear to be absorbing 60 to 70% of tariff costs today. However, we doubt that this will prove sustainable as a longer-term strategy. Nathan joins us now for more. Nathan, good morning.
Good morning.
Good to see you, sir. Which way do you think it breaks if it's not a long-term strategy?
Well, I think that the firms have been able to absorb as large a share of the tariffs as they have, largely because they front-loaded inventories and they're drawing down those inventories. But I think over time, they're going to have to pass it through to consumers. And I think we're going to see it in the CPI. To the extent that that doesn't happen, then firms' margins are going to be compressed and they're going to be thinking about how do I cut costs? And then that's bad news for the labor market.
So the question again, which way does it break?
Is
this an inflation story? Are they passing it on? Or a labor story?
Well,
are they cutting costs?
The Fed has cast its vote on that one. This is a tough period. The economy is absorbing a stagflationary shock. The Fed's got to choose between its mandates. And Jay Powell's telling us, well, it's painful, it's complex, it's difficult. But on balance, they're signaling greater concern about the labor market.
The market agrees with them. The market agrees this is the prudent route to take because essentially people are not pricing in a real reacceleration of inflation. Do you think that's correct?
I was very concerned about how the long end of the curve was going to respond to signals of Fed cuts. And as you say, the long end of the curve has responded very well as the Fed has shifted more in the direction of an easier monetary policy. And of course, the equity market is thrilled about an easier Fed. So at least so far, it very much seems that the markets are with the Fed, and they also, at least the preponderance of investors, are more worried about the labor market. One other angle on this that's helpful is that in the Fed's view, and I'm persuaded they're right, they see the stance of policy as still being restrictive. And so what they're doing is not providing outright stimulus, but they're just reducing the constraints on the economy as associated with monetary policy.
As an economist who's tasked with trying to put together all of these disparate trends and themes, how do you understand the moment we're in? Is it disinflationary? Is it reinflationary? I mean, I've heard an argument on all sides, and every time anyone makes an argument, I'm like, yes, you're right. And they're always the opposite sides.
Well, for the United States, I think it's stagflationary. And that's the reality of these tariffs. They're putting upward pressure on prices. They're putting downward pressure on real incomes and spending in the economy. And the Fed's trying to react to that. Now, for the rest of the world, the tariffs have a different implication. For the rest of the world, they are an adverse demand shock, reducing demand for exports, putting downward pressure on wages and prices. So I would say disinflationary for the rest of the world, stagflationary for the United States.
But in your global economic outlook, you talk about how consumers and companies were actually able to absorb it pretty well. Do you think that story is going to change?
So far, absolutely. Particularly here in the United States, we've seen resilience. Now, part of that I do think is a transitionary phase, and specifically, what's happened is the tariffs have come on gradually. And as we've seen the tariffs coming on, we say, well, prices are going to be higher tomorrow. What do you do if you think prices are going to be higher tomorrow? You buy more today. And so the economy has been supported through the first 6-8 months of the year through a front-loading cycle. That's now gradually abating. And when you get to the other side, all that stuff that we bought during the first half to get ahead of the tariffs, we won't be buying during the second half of the year. And that's where the payback comes in. We'll see the higher prices. And I think at that point, we are likely to see, I don't think we're going to see recession. I don't think we're going to see a collapse in economic activity. But a further slowing in the pace of growth is our expectation.
If inflation, though, is a concern pushed down the road then in 2026, what does that mean when we have a new Fed chair that is going to be very different than how Jay Powell views the world?
We are learning about how tariffs affect economies in real time. And for me, one of the big surprises has been that the pass-through of the tariffs into inflation has just been a lot slower than what I'd expected. The corollary to that is, we'll probably still be talking about tariff pass-through into inflation during the first part of next year. And it may be an issue even in the spring when we get a new Fed chair. Now, there's a lot of issues surrounding where a Fed chair appointed by President Trump may ultimately go. But managing the fallout of the tariffs is likely to be one important issue that they're struggling with.
When do you begin to ignore Chairman Powell?
I think he's got his hands on the steering wheel.
For how much longer?
I'm gonna argue until he leaves the Fed's building. I think he's still going to be the one who is largely going to be dictating the direction of policy, as long as he's chairman of the Fed. And I think part of that is he's got credibility with the other members of the committee, and I think that gives him influence and the capacity to shape policy.
Can he shape markets?
He
can at the moment, of course.
Yes.
But once we get closer to May, the reason I add this, as you know, the policy is not the interest rate, it's what happens in the market.
Yeah.
That we all understand that. And at some point later this year, there's going to be someone else who gets to say, you know what, I'm next. And his views, or hers, who knows, might carry more weight than Chairman Powell's.
Yeah. to the extent that policy is influencing the economy today and over the near term, and as you say, the horizon where his policy will be relevant is shortening and will continue to shorten as we approach May, then we're left to speculate on what a next Fed chair may do. But I think in terms of setting the table and determining where rates are, I think Powell's in control until May.
Nathan, it's good to see you. As always, thank you, sir. Nathan Sheets there of Citi Global. Chairman Powell doing his best to unite a very, very divided Federal Reserve at the moment. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent says the U.S. is discussing a $20 billion swap line with Argentina and is ready to buy the country's dollar bonds. The move is a vote of confidence from President Trump for leader Javier Milei after the two met yesterday here in New York. Argentine dollar bonds trimmed losses on the announcement. Meanwhile, we are seeing shares of Oracle down 1.7% after the company announced plans to raise $15 billion in investment-grade bond sales. People familiar with the matter say the software maker is selling debt in as many as 7 parts, including a rare 40-year bond. The deal comes as Oracle begins to fulfill massive cloud infrastructure deals with the likes of OpenAI and Meta, which are boosting expenses. And robot umpires are coming to the major leagues. MLB's competition committee approved the use of the automated ball strike system for the 2026 season. Human umpires will still call balls and strikes, but the robot will be introduced in the form of a challenge system in which the human umpire makes each call, which can then be appealed to the computer. That's your Bloomberg Brief. John?
It's about time. Honestly, don't you think?
100%. Absolutely agree. I mean,
Some
honestly,
people might say it's going to remove the beauty of things, like the history, the heritage.
Like getting mad at the
Aren't
ump?
fans just super frustrated with this at the moment?
I mean, honestly, at a certain point, as an ump, wouldn't you rather outsource it to a robot rather than get blamed and have people use your face as a meme?
And also, there's nothing really subjective about this. Like, this is not doing well in European football at the moment, but there really isn't anything subjective about this. Like, there's a box, and the ball needs to be inside it, and that's it. It's a strike.
Simple. Is the coach going to start screaming at the robot? Can you imagine the coach coming out, gets thrown out by the robot?
I just don't want sterile games. Like, were we going to outsource everything to robots and then just have players?
No, but this is one thing you can outsource quite easily. I think, anyway, for all my baseball knowledge. Up next, setting you up for the day ahead, we'll catch up with Tirupattur of Morgan Stanley following Oracle's $15 billion investment-grade debt deal with a 40-year piece. We'll get into that in just a moment. Live from New York City, this is Bloomberg.
Interestingly, as it relates to the bond market, we're seeing a lot more interest in bonds now because with rates coming down, investors are wondering, do I need to go out the curve? I've been living off my purchase money fund, but the yields on that are coming down. That's been a topic of hot debate among our clients.
It's going to keep Kathy Jones busy. That was Rick Wurster, the president and CEO of Schwab. As we count you down to the opening bell, here's the trading diary. A few things to look for. 4 p.m. Eastern time. Some Fed speak. Not much today, but it builds later this week. You'll hear from the Fed President Mary Daly later on. On Thursday, another round of jobless claims. Look out for that. Results from Costco too, and a host of Fed speak, this time from Goolsbee, Bowman, Williams. Friday, PCE data, UMich consumer sentiment to round out the week going into the weekend. Got a few more days to go. Let's turn to the Federal Reserve. Tirupattur, the chief fixed income strategist at Morgan Stanley, writing, we think the market pricing of Fed policy will move well below the September 24 low. They should skew towards a more dovish path. Vishy joins us now for more. Vishy, good morning.
Good morning.
Got a big credit offering to talk about with you in just a moment. I want to start with your view on the Federal Reserve because credit spreads are already super tight. Are you suggesting this market's not aggressive enough on rate pricing?
I think the path, I think the terminal pricing, we think you're suggesting is not aggressive enough. That's basically we are saying that we'll end up in a terminal pricing that will come down more than what we are basically suggesting. My colleague Matt Hornback and team are calling for the terminal pricing to come down by about 50 basis points further down.
So that's much more more accommodative than where we are from a rates perspective at a time where credit markets are wide open. John was referring to the credit offering Oracle selling $15 billion of bonds this morning, including 40-year debt, which is rather rare, especially given the fact that this is a technology company that's touting things that haven't fully been developed yet. What does that say to you about just how accommodative this credit market already is?
The credit market is accommodating. The way I look at it is, from a fundamental basis or technical basis, but perhaps the best way I would capture it is accommodative. Spreads are tight. Undoubtedly, spreads are tight. They're tight since 1998, tight. But the spreads are tight, but yields are right, is a line I would like to go with. Because if you look at you're still able to get to somewhere in the 5-6% yield. At that level of yield, there is actually pretty substantial demand, particularly from insurance companies selling sort of fixed annuity type of products. So that yield demand is insatiable. As long as the curve is steep, the steepness of the curve stays, I think we'll continue to see that technical demand coming through, and we think that we are in a good place.
I'm going to put you on the spot. Be a little more specific. This 40-year tranche is being sold at about a yield that Oracle would be paying for the privilege of borrowing for 40 years of almost 6.5%. That might be decent for some of these insurance companies. Is it a good buy, given that we don't know the technology, that we don't know the rates picture, we don't know inflation? How can you measure out 10 years? How can you measure out 5 years, let alone 40?
I'm not going to cop out. I'm not copying out, but I won't talk about a particular issue. I don't know what our involvement is, and I don't know if you've written it yet or not on this. So I will pass on specifically commenting on this particular bond deal. But overall, all I want to say is that as long as we have, if you look at the fundamentals, we have not seen any substantial deterioration in leverage. We've not seen substantial deterioration in coverage. Cash to debt ratios have somewhat come down. But overall, we think that the credit fundamentals are in a pretty decent shape. So we have not seen, since post-COVID, we have not seen excesses in credit that we would, the credit market is prone to doing excesses. Really haven't seen a lot of that. Also, issuance, total issuance volumes, net issuance is effectively flat. We're not seeing this abundance of issuance, not seeing an abundance of debt-driven M&A, LBO type of activity. That will sound caution, that raise caution from the investor perspective. We're not seeing any of that. So this month, we might end up with something like 170 billion of issuance, and which basically sets the average September from post-COVID to now. We are just sitting right there. So we're not seeing that exuberance. Where I would be watching is if we start seeing a lot of debt-driven M&A, a lot more LBOs, and you saw equity contribution come down, debt contribution go up. That's something we are watching really closely. We're not seeing any of that yet.
Vishy, I think about this in really simple terms. When you say that credit spreads are tight, but the yield is right, the way I see things is when credit spreads are tight, the greater percentage of the yield comes from the risk-free asset. So why wouldn't I just own that instead of assuming the additional credit risk when I don't feel like I'm really being rewarded for it? How do you sort of confront that question from clients at the moment?
Absolutely. We get that question a lot. So the kind of products that are driving the liabilities that these assets are supporting simply are looking for yields in the 5 to 7% type of levels. So below that, if you're an insurance company, you're not competitive. You can't offer a competitive rate just purely relying on the treasuries. You can't get that number. So you need to get to that a competitive rate that you need a spread product, whether it's corporate credit, securitized credit, et cetera. You need that spread product.
Isn't that a different question, though? That's like saying that these institutional investors right now are being forced into the product because they've got no choice. But as an individual investor, I've got a choice, haven't I? I can sit here and say, I don't want to be forced into anything. I don't like that.
As an individual investor, what people are responding is buying these annuities, which is basically are effectively giving you that above, keep up with inflation, meaningfully above money market rates, and annuity products are very popular. Now their annuity product sales have quadrupled from the pace of post GFC to COVID levels. We have in the last few years, we have seen it quadrupled. And that's basically saying we want something better than a money market, something safe, something that could be relied on. And to defease that liability, you need a product that has a spread product in the, as I said, 5-6% yielding product. And that's precisely what credit is offering. And I mean credit in a broad sense, not just corporate credit.
What I'm struck by is there hasn't been a lot of issuance at the long end of the yield curve, and I'm talking about corporate and a whole vast number of credit issuance. If there is demand, Wall Street will create it. You said that you're worried about debt-driven M&A, debt-driven transactions. Isn't this market begging for that, given the demand and the lack of supply that really can feed that demand?
So what I should state it this way. I think we'll be watching how much of debt-driven demand, how much of debt-driven M&A, how much of debt-driven LBO happens, and what are the multiples things are being done at. So at the moment, what we are seeing so far doesn't rankle so far. So if we start seeing things like that, then we'll be more worried. At the moment, we are not. I am more worried about a bull flatter yield curve. A bull flattening is going to be much more of a challenge for this yield-driven environment. And that would be much more challenging.
We had that at the start of September. Is there a reason why that's just a blip? Doesn't continue?
We need significantly more bull flattening than we saw. So we need, basically, if we saw yields come down to the levels that we saw before 2020, in the post-GFC, pre-COVID levels, where we really didn't see that. It was a flatter curve, and that really was not the driver of that it's become today. So I would be much more concerned about a significant bull flattening, more so than what we saw last year.
Vishy, always a clinic. It's good to hear from you, sir. Appreciate it. Thanks for breaking it down in simple terms. Vishy Tirupattur there of Morgan Stanley on fixed income and the latest developments in the credit market.
Yeah, not concerned. Even though we are seeing a lot of issuance, it's not enough issuance to really meet the demand. The idea of a 40-year tranche from Oracle, which a lot of people are raising questions for, but
I have the same questions that you do. 40-year tech, is it a 40-year bet? How many people are buying that and holding it for 40 years?
Well, maybe some of these tech companies, maybe some of these insurance companies. If they're getting 6.5% yield on it, do they even care what's underlying it as long as they keep getting paid?
Coming up tomorrow, bigger debate on this one with Matt Miskin of John Hancock Investments, Scott Cronin of Citi, Brent Shuley of Northwestern Mutual Life Insurance, and Neela Richardson of ADP. From New York City this morning, good morning. For our audience worldwide, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.